Ladies and gentlemen, distinguished guests, it's a great pleasure to welcome you here to the 9th Annual Research Conference of the National Bank of Ukraine, held in collaboration with Narodowy Bank Polski. I would like to express sincere gratitude to our partners, in particular International Monetary Fund, which has supported this conference since its launch in 2016, and German Society for International Cooperation, a state organization of the federal government, Federal Republic of Germany, that operates on behalf of the German government and the European Commission in about 120 countries worldwide and implement international technical assistance projects across various sectors. This year's conference, Economic and Financial Integration in a Stormy and Fragmenting World, brings together leading policymakers, experts, researchers from across Europe and beyond to reflect on financial and economic systems can adapt, evolve, and contribute to stability and prosperity in increasingly uncertain global environment. As Ukraine continues its path toward EU membership, the themes of this year's conference is especially timely. We will discuss the implications of the EU and the role of financial markets in fostering resilience and growth. This year's conference are not only crucial to Ukraine, but also to the EU and its partners seeking to build stronger and more interconnected Europe. Due to our unique venue today, we will be able not to interrupt our conference because of air raid alerts, and during the event, simultaneous translation into Ukrainian is provided. If you need it, headphones are available at the end of the call. Dear colleagues, every event in Ukraine begins with a moment of silence. So I kindly ask you to honor those who have lost their lives because of Russia's brutal war against Ukraine. Thank you for sharing this moment of silence, and now we can return to our program. So now, without further ado, I would like to open the 9th Annual Research Conference, and I'm pleased to invite Governor of the National Bank of Ukraine, Andriy Pyshny, to take the floor.
Шановні гості, колеги, друзі, пані та панове, це особлива мить. Давайте перевіримо, чи працює переклад. Одну секунду. Чудово. Шановні гості, колеги, друзі, пані та панове, це особлива мить. Особливо не лише тому, що ми відкриваємо 9-ту
special not only because we are opening the 9th Annual Research Conference, but also because we are doing it here in Kyiv. In this city that became a symbol of resilience, in the capital city of the European country that once again suffered a deadly Russian attack and once again holding its ground, in my country that has not surrendered and will never surrender. That's why I would like to start with the words of gratitude to all our speakers who made it possible to be present here today in this room. The special privilege is to receive the President of the European Central Bank, Ms. Christine Lagarde, who was kind enough to agree to make a keynote speech. It should be noted that it is a historical visit because the president of the European Central Banks is visiting independent Ukraine for the first time ever. We Ukrainians learned very well to distinguish sincere empathy from formal protocol. We appreciate your willingness to breathe the same air as us, even though it smells of smoke, and to stand with us under the same sky, even though missiles are falling from it. Your arrival, your presence, is not just an act of academic solidarity. It is a political action. It is a contribution to the new European reality we are creating together. Let me start our journey of exploration within this conference with the following thought. Today, we live in a world that is rethinking itself. Geopolitical fragmentation, deglobalization trends, technological disruptions and challenges, crisis of trust, radical populism and wars. All this creates a sense of not only anxiety, but also chronic uncertainty. But being at the epicenter of this uncertainty and observing the process, I will take the liberty of stating the first message of my speech. Uncertainty is no longer a challenge without response. It is transforming gradually but irreversibly. And more it is becoming a catalyst for decisions. And these decisions are changing the vision and the very architecture of the global order. Over the past few years, we got used to talking about uncertainty as the new normal. However, it is time to look at it differently. It has already begun to transform into an understanding of priorities. It made it to focus on strategic conclusions and create new form factors of cooperation. It may sound odd, even paradoxical, but one of such form factors is integration, but not as a political declaration gathering dust, but as an active antithesis to fragmentation. Integration not as an ordinary political symbol, but as a tool for survival and a conscious source of strength in the world of turmoil. It is interesting to note that one of the manifestations of this transformation is change in the narratives of central bank governors. Cautious and traditional messages are now being supplemented by decisive and bold ones. This is something I'm noticing more and more at our international meetings and in their speeches. Central bankers have power and independence. They are aware of their responsibility and are strengthening their voice. Defense and geopolitics, security and the risks of populism. Today, when commenting on these topics alongside monetary policy decisions, central bankers do not go beyond their mandate. On the contrary, they influence the conditions under which this mandate is fulfilled. But let's return to integration as a source of strength. There is no better example of the transformative power of integration than Ukraine. We are not just changing every structural element of our system. We are joining a new European architecture. We are pushing Europe forward. Ukraine is not just an object of integration. Ukraine is a source of renewal for the European Union. I believe that we are not creating strategic challenges for Europe. On the contrary, we are reducing them. We are the answer, not the question. I like to think about this in the words of the French philosopher Albert Camus. In the midst of winter, I found within me an invincible summer. Thus, in the midst of the storm that Europe is going through, Ukraine can become a source of determination, dynamism, and revival. Let me offer a few points that I believe best illustrate this. First, the institutional capacity of the Ukrainian state remains strong after 1,220 days of the full-scale war. Its economy has survived, and despite deep wounds and scars, it's recovering step by step. Its financial system demonstrates resilience, thanks in particular to joint efforts and financial support of our partners. The banking sector is operationally stable, liquid, and profitable. Inflation is a permanent challenge fueled by the war, but we know how to deal with it. At the same time, we demonstrate the manageability of processes and preserve flexibility and adaptability of our policies, which allows us to maintain trust and macrofinancial stability and fulfill our mandate under any circumstances. The National Bank of Ukraine is one of the examples of resilience and transformation. Not only we continue to reform the financial sector and maintain independence, we are strengthening it in the face of war. We learned to see the value of central bank independence as a public good that underpins policy effectiveness. The phrase "independence is not in question" is entirely relevant for Ukraine. We realize that our institutions must meet European standards so that Ukraine can become a part of the EU's collective decision-making process. Institutional stability is our asset and our future contribution to the European stability. We are prepared for this. And perhaps one day, the Governing Council of the European Central Bank will conduct its meeting in Kyiv. Second, EU enlargement is not a risk, it's a source of strength. The history of the EU confirms that the previous waves of enlargement in 2004 and 2007 led to a 30% increase in GDP per capita in the new member states compared to the alternative scenario without accession. At the same time, in the old Europe, the per capita income grew by 10% thanks to the scaling effect of the single market. This is clearly demonstrated by the results of the recent IMF study. Poland, that was considered a risk, became an engine of growth. Today, its GDP per capita exceeds 80% of the EU average. This underscores the fact that deeper integration into the EU has benefited everyone without exception. New member states have seen a leap in living standards, while core Europe has enjoyed tangible growth thanks to the expansion of the single market. Indeed, Ukraine's accession to the EU was not free of charge. However, according to estimates by the European Policy Center, Ukraine's integration will cost 0.07 to 0.09% of the EU's GDP per year. The price of integration could be reduced if the frozen assets of the aggressor country were used to finance Ukraine's reconstruction. This is not only economically feasible, but also morally and legally justified. Those who destroyed must pay. When EU countries' budgets are limited, this approach makes it possible to reduce the pressure on taxpayers while ensuring recovery on a sustainable basis. The third point is that unification is a prerequisite for mitigating geopolitical risks. The experience of the Baltic countries shows that joining the EU and NATO reduces risks, not the other way around. The IMF data show that candidate status reduces sovereign premiums by nearly 200 basis points, as markets perceive integration as a stabilization factor. Ukraine's accession will enable the EU itself to better manage these risks. Through the exchange of experience, digital and energy integration, and the use of the country's existing potential. Ukraine's military assets deserve special attention. I suggest to have a look at them as a contribution to the EU's collective defense capabilities. Potential costs of Europe could be set off by Ukrainian defense resources. After all, Ukraine has the most combat-ready army in Europe today. Europe will be stronger and more capable with Ukraine. Without Ukraine, it will be weaker. This is no longer the opinion of the military, but also of economists and central bankers. How can we forget the recent statement by Olli Rehn, the governor of the Bank of Finland? Supporting Ukraine and reinforcing European defense is an imperative for the security of the whole Europe. The war has demonstrated that security is not just an expense. It is a priceless public good. It is a prerequisite for sustainable development. I can hardly find better words than those of Madame Lagarde in her speech in Berlin. Europe must ensure a strong and reliable geopolitical foundation, maintaining commitment to open trade and the strength of security capabilities. Madame Lagarde calls for joint efforts to build up military and defense capabilities in the context of strengthening the global role of euro. Let me elaborate on this point. The possibilities for achieving this goal are not obvious without the integration of the most combat-ready force in Europe, the Ukrainian armed forces. Fourth, Europe should not fear competition from Ukrainian companies. On the contrary, it should be encouraged. The EU needs to update its internal rules of the game, in particular by strengthening competition as a driver of efficiency and innovation. This is one of the key conclusions of Mario Draghi's report. Instead, market fragmentation, regulatory barriers and weak competition are holding back the potential of European businesses. This prevents the emergence of European champions capable of competing at the global level. To achieve greater autonomy and influence for Europe, a real breakthrough in developing the internal market is needed, including deepening competition in digital technologies, energy, finance, and defense. And this is the quote from another important report by Enrico Letta. These conclusions are obvious. They directly contradict the fears of some EU countries regarding the competition from Ukrainian producers. In essence, this competition is an opportunity for the EU to strengthen its economy, increase productivity, and move closer to its own strategic goals. This is the key to the EU's strategic autonomy. I will say more. Ukrainian businesses, shaped in conditions of the war and harsh adaptation, are relevant examples for a qualitative renewal of approaches in the EU itself. They will stimulate old economies to rethink their efficiency, speed, and flexibility. This is also a precondition for development. I will also add that the structure of the Ukrainian exports is quite complementary for the EU. In the agri-sphere, these are food and grain, not wine, cheese, or oil with oil. In machine building, these are spare parts to European machine building. And in the future, potentially the products of military technologies. In the ITs, these are high-quality services that will make European countries more competitive in the global market. The lessons of previous waves of enlargement show that adaptation through transition periods and other instruments works. So, should a united Europe fear producers from Ukraine? Another important statement, a reservation, is food security. This is one of the key factors for price stability, at least in 2021 for the EU. Ukraine's agricultural potential could become a kind of insurance policy for Europe in the face of climate shocks and geopolitical blockades. Competition is what the EU needs to become more efficient. Ukraine is a catalyst of this process. The fifth statement, Ukraine's integration into the EU will not trigger a new wave of migration. Migration process is a pressing issue for Europe today. It is too politicized. The Ukrainian labor market could indeed pose significant risks for the European market. However, Ukrainian migrants, including those who were forced migrants, even before formally joining the EU, are already well integrated into the EU labor market, and their contribution to the GDP and social systems is significant. According to a recently published study by the Office of the United Nations High Commissioner for Refugees, the net contributions of Ukrainians to Poland's GDP in 2024-27 will reach 2.7%, and the employment rate will increase from 61 to 67%. I would also add that Ukrainian migrants in many EU countries have already paid more taxes to the budgets of the recipient countries than they have received in aid. If we scale up this example, Ukraine's accession to the EU will create additional budgetary space by increasing the size of the Union's economy. Our common task is to create conditions for circular mobility, the return of the Ukrainians home, and stabilization. Ukraine's accession to the EU is not a trigger for migration, but the tool of balancing. The experience of the Baltic states and Poland has shown that 25 to 30% of migrants return within 5 to 7 years after stabilization. And finally, the sixth statement, moving towards the EU financial regulations will increase the benefits for the development of the entire European financial sector. Ukraine has significant potential for the development of financial services and the capital market. The level of financial depth remains low. On the other hand, this offers enormous prospects for consolidating savings, developing insurance and pension funds, accumulating investment capital. On the other hand, the financial sector is critical for Ukraine's sustainable recovery, defense financing, and long-term projects. We note that Ukraine's financial sector is flexible, innovative, profitable, and customer-oriented. Market players are not only able to respond to customer needs, but they have also learned to overcome unprecedented challenges and to adapt. They increased European presence, and accordingly, knowing Ukrainian practice is an impetus for improving financial services in the EU itself. Of course, integration does not mean the mechanical implementation of each and every norm of the acquis communautaire. Fully implementing EU legislation is a significant challenge for any candidate, and even more so in our context. It's like catching up with a target that not only continues to move forward, but also often changes its speed, direction, and sometimes its final destination. The EU regulatory field is changing, and we desperately need to move towards it. The movement must be mutual. I would like to recall again Mario Draghi's report. Sometimes what's needed is not more regulation, but deregulation to boost competitiveness. Ukraine is exactly the case where we can once again create a win-win situation. Regulation, not dogmatism, but smart architecture that needs to be calibrated by smart regulations. A sufficient minimum where necessary, awareness of every decision. This is exactly what Europe is striving for today, and this is exactly what Ukraine wants to achieve. This is a new space for our joint action. Let me conclude my speech with the words of Jean Monnet, who sought a large-scale European Union, political, military, and economic. He said, Europe will be forged in crisis and will be the sum of the solutions adopted for those crises. Today is the time for such solutions, and Ukraine's integration to the EU is one of them. Integration is not a matter of charity, it's a matter of strategy. It is not a concession, it's a strengthening. We are not asking for privileges. We seek, with gratitude and all respect, a comprehensive partnership. We are not demanding that the rules be changed. We affirm our readiness to comply and remind you that the rules should work for the stability, development, strength, dignity, and values of Europe. This is our goal and our reality. And yes, this is a moment when history pace is accelerating, and those who are ready to act will not disappear, but will shape the future. Ukraine is the answer, not the question. Thank you for the attention. Glory to Ukraine.
Governor, for your inspiring speech and a clear vision of Ukraine's path to the European Union. Unfortunately, our representative of our co-organizer, Narodowy Bank Polski, couldn't be with us today in person. However, we are pleased to share a video address from Ms. Marta Kaitley, First Deputy Governor of Narodowy Bank Polski.
товариства міжнародного
In a central banker's life, it is sometimes necessary to choose among our duties. Although I'm not in Kiev in person, I'm with you with my heart and soul, and I will follow the debate online, listening with attention and keeping my fingers crossed for the success for our central bank's joint endeavor. I would like to begin by thanking all participants for attending. I'm grateful to Andriy Pishny, the Governor of National Bank of Ukraine, for his hospitality, and to the representatives of the International Monetary Funds as well as GIZ for their presence. We also appreciate the contribution of our keynote speakers, Christine Lagarde, President of the European Central Bank, and Professor Kenneth Rogov, as well as our presenters, panelists, and discussants. I would like to acknowledge Andrew Bailey, Governor of Bank of England, for preparing a special address. Finally, I extend my thanks to the teams of National Bank of Ukraine and Narodowy Bank Polski for the efforts in organizing this event. The theme of this conference, Economic and Financial Integration in a Time of Turbulence and Fragmentation, reflects the pressing question facing policymakers and researchers alike. Several sessions will focus on European integration, which has often been viewed as a case for institutional and economic coordination. While it has brought about important forms of cooperation, it continues to face complex challenges, including the aftermath of the Eurozone crisis, the economic impact of COVID-19 pandemic, and the consequence of Russian full-scale invasion of Ukraine. These developments have underscored the importance of international resilience and adaptability. Crises often reveal structural vulnerabilities, but can also prompt necessary reforms. As Jean Monnet noted, Europe will be forged in crisis and will be the sum of the solutions adopted for this crisis. This observation remains relevant, and international efforts continue to evolve. For Ukraine, European integration has become a strategic objective. Since the Euromaidan movement in 2013, public debate has increasingly focused on closer alignment with EU structures. The application for EU membership, submitted shortly after the onset of Russian full-scale military aggression against Ukraine in 2022, marked a formal step on that path. However, integration is a long and complex process. It's important to approach it with a clear understanding of institutional and economic adjustments it will require. The conference program reflects this complexity. Over the next 2 days, we'll explore a broad spectrum of themes that capture both the promise and the challenges of economic and financial integration in today's world. The agenda combines high-level policy panels and research sessions, offering a mix of strategic discussions and analytical depth. We begin with a focus on EU enlargement and its implication for the financial sector, an issue that continues to shape institutional and regulatory developments across the continent. Discussions will also examine the evolving relationship between the single market and the emerging industrial policies, particularly in the light of shifting priorities around strategic autonomy and economic security. Another major threat of the program is the role of financial markets in supporting competitiveness and long-term development. Panels will assess how cross-border coordination can contribute to a more dynamic and resilient European economy. These policy dialogues are complemented by research sessions that offer evidence-based perspectives on fragmentation, institutional resilience, and the new geoeconomic geometry. The agenda includes studies on how geopolitical realignments and sanctions also influence trade in countries undergoing economic transition or conflict. In parallel, we will explore the broader macroeconomic consequences of fragmentation, how supply chains are being reshaped, how firms are adapting, and what this means for future integration efforts. Sessions on financial inclusion and sectoral reform will reflect the realities faced by countries navigating EU accession and highlight the importance of inclusive growth and institutional capacity. This combination of forward-looking policy debate and rigorous research aims to provide a deeper, more informed understanding of integration in a world that is neither as cohesive or as predictable as it once seemed. I looked forward to the valuable insights these discussions will generate. Thank you once again for your participation, and I wish you a productive and engaging time here in Kiev.
That was a video address from Ms. Marta Kajt, the first Deputy Governor of Narodowy Bank Polski. And now we move to our next speaker who are here with us today offline. So I will give now the floor to Ms. Priscilla Tofano, the IMF resident representative in Ukraine.
Governor Pishny, President Lagarde, dear distinguished guests, colleagues and friends, let me begin by thanking the National Bank of Ukraine for the opportunity to speak at this year's annual research conference on behalf of the International Monetary Fund. It is the first time for me, and I feel very honored to contribute to this discussion. The partnership of the IMF with the MBU is long-standing and it is deep. It began shortly after Ukraine regained its independence and joined the IMF in 1992, and it continues today through our ongoing program, IMF program that we have here, the Extended Facility Program. This program is very important both for both of us, actually, for both the IMF and Ukraine. For the IMF, it is the first time that we are providing program financing to a country in a full-scale war. It is the first time. And for Ukraine, it is the first time an IMF-supported program has reached a 7th review, with the 8th review now not too far, just a few weeks away. This milestone testifies not just to the authorities' commitment to reform, but to the resilience of the Ukrainian economy, to the resilience of the Ukrainian institutions, and to the professionalism of their staff, especially the staff here at the MBU, and the staff also at the Ministry of Finance, who are implementing economic reforms under what I think we agree are very difficult conditions. We are also proud to co-sponsor this conference through the Ukrainian Capacity Development Fund, which has mobilized $36 million in contributions to date. This fund has been instrumental in helping sustain Ukraine's reform momentum through exceptionally difficult times. This fund has supported technical assistance in areas ranging from financial regulation, supervision, central bank operations, virtual assets, and AML-CFT frameworks. The IMF is also well represented at this event, with 3 colleagues traveling from Washington to participate in panel discussions today, Jeroen Klik, Vitas Vasiliauskas, and Vlad Rashkavan from the executive board. And I think they don't need any introduction because I think that Ukraine and the NBU knows them well. And I see also other colleagues in the audience. I know that there are going to be other colleagues tomorrow in panels. So I'm very happy about that. And I think that this participation of my colleagues reflects not only the IMF institutional support to this event, but also our commitment to listening, learning, and contributing to Ukraine's policy discussions. And let me now turn to the theme of this year's conference, which is economic and financial integration in a stormy and fragmenting world. This topic, as you know, lies at the very heart of the IMF mandate. As you know, the IMF was created in the aftermath of World War II. actually to promote international economic cooperation and integration, and to prevent a return to the economic nationalism that had proved so destructive after the First World War. In the early years of the IMF, and actually at least through the 70s, the results were impressive. Post-war growth was high in the world's richest economies, and also more broadly shared within these economies, and developing countries too saw their per capita incomes grow. Despite the move to floating exchange rates, globalization actually increased. Trade expanded much faster than global GDP, and not just because of the creation of the WTO, but also for reasons of technology. The advent, for example, of container shipping, which reduced transportation costs, but also the advent of the internet, which facilitated communication across countries and allowed for products to be sourced and traded around the world, creating global value chains. This lifted growth and reduced poverty. So we can say that from the late 90s to up until around 2008, these trends accelerated in a period that actually we could consider of hyper-globalization, with trade rising as a share of world GDP and capital flows rising even faster. But in the past 15 years, the trajectory has changed, has shifted. The global financial crisis, Brexit, international trade tensions, the COVID pandemic, and the Russia's invasion of Ukraine have all contributed to a rethinking of globalization. In part, this is because of the social tensions within countries blamed on increased openness and immigration. But maybe, ultimately, this rethinking, this shift, was caused by technological change and the failure of governments to caution its impact on society. Trust towards the international system and between countries has also eroded. It is eroding, we see it today. Trade restrictions have increased, and we are witnessing a reordering of trade and investment flows along geopolitical lines and guided by strategic considerations. As our managing director said a couple of months ago in the opening, on the spring meetings in Washington, today where things are made may matter more than how much they cost. And governments now believe that a broad range of strategic goods, from computer chips to steel, need to be made at home. They need to be made domestically, even if it is inefficient, in order to increase self-reliance and in order to protect from disruption and overdependence on global supply chains. And this is what we call this phenomenon geo-economic fragmentation. There is a precedent for this, and it is in the Cold War. So trading patterns during the Cold War offer a historical precedent for what fragmentation could look like today. During the Cold War, global trade rose overall, but trade between the Western, let's call it the Western bloc and the USSR bloc collapsed relative to trade within blocs. And recent research from the IMF, including that led by our first deputy managing director and others, Geeta Gopinath and others, suggests that we may now be entering in a similar period. Trade, FDIs, financial flows have started to decline, even if the decoupling is still modest if we compare it to the Cold War. But we know that if geopolitical tensions intensify, if trade restrictions continue, then this fragmentation can worsen further. We know that economic fragmentation disrupts trade, disrupts capital flows, technology, it disrupts international cooperation. It also creates a lot of uncertainty, especially in the transition period. This uncertainty is costly. It leads firms to delay investment, it leads households to save more, and financial markets to become more volatile. And Ukraine, of course, knows the cost of this uncertainty maybe better than anyone else. And Governor Pishny actually emphasized this, both at the conference we went to together a couple of days ago, organized by the Banking Association, but also today. saying that navigating this uncertain environment is very difficult, including for the financial sector. And the IMF recognizes this too, because in our program with Ukraine, we explicitly recognize and we design it in order to take into account what we call exceptionally high uncertainty stemming from the war. This conceptual framework influences how we assess risks, how we build scenarios, and how we structure program design. So what can countries in general and Ukraine in particular do to navigate this world of rising fragmentation and stormy uncertainty? So I'm sure this conference, will provide a lot of insights, but let me briefly outline 2 strategic directions that Ukraine is pursuing and that directions that we're also embedding in our current IMF program. So the first one, it is that Ukraine needs to redouble its efforts to strengthen its own economic foundations, its own fundamentals. Because in a world where shocks are so frequent and so uncertainty is so high, as we said so far, reforms cannot be delayed. And maybe this is the window of opportunity, actually, to introduce reform, the fact that there is so much uncertainty and that the situation is so difficult. So the macroeconomic stability that Ukraine has achieved must be preserved, and growth potential has to be expanded. And we focused on this on our program. In particular, in our program, we aim to mobilize domestic revenue to ensure that Ukraine has adequate resources to meet social spending, infrastructure, and defense needs, which are going to be high even after the war is over, while restoring that sustainability in the medium term. Maintain price stability by adopting the appropriate monetary stance to manage inflation and anchor expectations. Enhance exchange rate flexibility to absorb shocks, limit external imbalances, and preserve international reserves, and advance governance and anti-corruption reforms to ensure fairness, level the playing field, attract investment, and actually then put the basis for a solid growth going forward. And the second direction to which Ukraine is committed, which has just been mentioned, is a European integration path. Deepening ties with other open economies, with like-minded economies, could not only strengthen economic resilience, but also could lift growth and also strengthen political alliances. Ukraine's program, the program that we have at the IMF, is firmly anchored in this path, with many reforms aligned to meeting the EU acquis, both in fiscal policy, financial regulation, and governance. With this, let me conclude by reiterating the IMF support for Ukraine, the MBU, the other Ukrainian authorities, and also our support for your collective reform agenda. I very much look forward to hearing your insights, to hearing the panel, starting from the next one, and I look very much forward to the discussion. Thank you very much.
Thank you, Ms. Stefano, for your thoughts and for your contribution. And now it's my honor to invite Maximilian Rush, Deputy Head of Mission at the Embassy of the Federal Republic of Germany to Ukraine.
Governor Pischny, President Lagarde, Excellencies, representatives and partners, colleagues. It's a great pleasure and honor being here today. The resilience of Ukraine is truly remarkable and serves as an example for all of us. You are at the front line of a fight for our shared European norms and values. Germany will stand at your side as long as it takes. With more than 48 billion euros since 2022, Germany is the second biggest supporter of Ukraine. And we will continue our support to Ukraine in many different areas, covering financial, military, humanitarian, and technical support. And German businesses are invested and will invest in Ukraine. Our aim is to welcome Ukraine in the European Union as soon as possible. The European Union is where Ukraine belongs. Also, with this in mind, I'm glad that the German government is strongly supporting the further reform process of the Ukrainian financial sector in view of, first, its path towards EU accession and the implementation of regulatory requirements, and second, in the area of providing financial and technical support in the area of access to financial services for small and medium enterprises. In the last 1.5 years, our implementing organization GIZ has established a close relationship and cooperation with the National Bank of Ukraine and provided some meaningful technical and expert support. This cooperation has involved a series of workshops and gradual implementation of EU regulations and standards in the process of EU accession. Besides very technical and legal issues, the challenges and experiences of other countries, as well as the expectations from EU institutions such as the European Banking Authority and the European Central Bank, have been discussed in great detail. These events brought together central bankers also from other new EU member states, economists, policymakers, researchers and practitioners to discuss and develop solutions on the most pressing problems under the current circumstances of war. And it is so great to see that the NBU and the whole sector have done so well despite all the challenges posed by the Russian aggression. We understand that issues regarding stability of the financial sector are a precondition for a prospering economy and growth. This is as important as a promotion of creating an inclusive environment in which companies, first of all micro, small and medium-sized enterprises, will get access to urgently required financial services. The German government addresses both aspects through technical and financial cooperation. The NBU will continue to be a key partner in the new program Step into EU, which was launched last month. Other key players in the Ukrainian financial sector, such as the associations of banks and insurance companies, the Business Development Fund, the Export Credit Agency, and financial institutions, will significantly contribute to the success of the financial sector approach of this new program. Allow me to mention some main elements of this new program. We are planning to intensify the exchange of the NBU top management level with experienced advisors of central bankers from new EU member states, for instance, from Croatia. Meaningful inputs and peer exchange of view of these countries and their central banks' path towards EU integration and respective EU screening procedures will surely be useful for the NBU and other Ukrainian financial sector institutions. Together with the banking associations of Ukraine, a wide range of implementation and training measures will be provided for state-owned and private financial institutions, also including new innovative digital market participants. Regarding the joint efforts of further reforms and EU accession, we are planning to facilitate a dialogue between the NBU and the banks on the roadmap and priorities of implementing standards and concrete steps of reform in the financial sector. In the area of access of companies to financial services, including loans and grants for micro, small, and medium-sized enterprises, the German government will step up its support to the Business Development Fund. For example, a new innovative countrywide IT platform for SMEs will be developed that allows truly transparent and standardized applications of SMEs for financial investment means. With this IT platform, which will match the demand of investment capital with the supply provided by banks, we want to boost SME financing in Ukraine at a large scale. And furthermore, through an improved coordination with the SME Resilience Alliance, which was launched in the Ukraine Recovery Conference in Berlin last year, we will contribute to a better coordination of international support for the SME segment and to identify their financial needs in the future. Today's and tomorrow's conference is an important step for Ukraine's journey toward the EU and the beginning of a new stage of German cooperation with the NBU and many other partners. We thank the NBU for the good and trusted cooperation. We share common goals and we stand with Ukraine, as I said, as long as it takes. So I wish us a successful conference. I thank you and Slava Ukraini.
Thank you, Mr. Rao, for being with us and for your support. We are sincerely thanks to the representatives of organizers and partners for their inspiring and informative remarks, which have set the tone of the whole day. And now I know that we are preparing for a special moment, and I'm honored to welcome the first keynote speaker. But for introducing and later moderating the Q&A session, I would like to give the floor to Deputy Governor of the National Bank of Ukraine, Serhiy Nikolaichuk.
Dear colleagues, dear guests, it's a great honor for me to welcome our keynote speaker, the President of the European Central Bank, Christine Lagarde. First and foremost, I would like to repeat our sincere gratitude to Madam President for personal participation in the event. Her presence in Kyiv, especially in these extraordinary times, is a powerful gesture of solidarity, one that we deeply value. Madam President, we are truly grateful for your willingness to experience the Ukrainian context and to witness firsthand realities of the country, defending its sovereignty while advancing steadily along the path of the European integration. Your participation in this conference is both important and symbolic, not only because of your extensive practical experience, but also due to your exceptional leadership in advancing financial and economic integration on the global stage. In this context, it is impossible not to reflect on the remarkable career of Madame Lagarde. Throughout her distinguished career in the government, at the helm of the International Monetary Fund, and now as the President of the ECB, Madame Lagarde has been tireless advocate for stronger, more cohesive economic governance and cooperation. Madame Lagarde plays a central role in shaping the European Union's strategic direction. Her deep understanding of the challenges confronting a united Europe is matched by her clear and visionary thinking on how to strengthen the EU's economic resilience, institutional integrity, and global standing, including through a stronger role for the euro. Equally inspiring are her unwavering belief in the promise of European integration and her resolute rejection of fragmentation, values that resonate powerfully in the current geopolitical landscape and especially here in Kyiv. Madam President, we are truly honored by your presence. We now look forward to your keynote speech. Please, the floor is yours.
Thank you so much. Thank you. Dobry ranok. Bonjour. And also good morning. My dear Andrei, ladies and gentlemen, ambassadors, honorable guests, and previous speakers, it is a great honor to be here with you today. And I would like to first of all express my gratitude, our gratitude for your hospitality, Andrei, and to your entire team. You invited me to come. I promised you I would. I didn't come alone. I came with my husband, and I came with the lead members of my team so that we could breathe the same air as you and be under the same sky, whatever falls from it. It's a pleasure and an honor to be here in Kyiv. It's a city, as you said, which has come to symbolize resilience, dignity, and the enduring spirit of freedom. Kyiv stands not only as the heart of Ukraine, but as a beacon of what it means to hold fast to democracy, to its values, in the face of the immense challenge that you face. As the great Ukrainian poet Taras Shevchenko once wrote, I'll translate in English not to offend you, beautiful language. In your own house, your own truth, your own strength and freedom. And Ukraine's fight today reminds all of Europe of this powerful truth. Our security and our prosperity rely on our unity and on integration with our neighbors. In the face of Russia's unjustified war of aggression, Ukraine has demonstrated extraordinary courage and resilience in defense of their country and its democratic values. My dear Andrei, in your beautiful opening remarks, you demonstrated that we should not see Ukraine as a threat, that we should see Ukraine as an opportunity, that we should see Ukraine as a stimulus, that we should see Ukraine as a shield and as a catalyst. And while we did not coordinate, you and I, our remarks, I will try, in keeping with the theme of the conference, I will try to reflect on recent history lessons that we have learned about strengthening and integrating economies in an increasingly stormy and fragmented world. The experience shows that closer ties with European neighborhood can provide a strong foundation for Ukraine to rebuild and emerge stronger. And as geopolitical tensions rise and global supply chains fragment, the case for deeper regional integration, mutually beneficial to all, has never been as strong. Europe's own long journey of integration after a devastating Second World War offers valuable insights that can help guide Ukraine's path forward. Two key lessons stand out. First, deeper integration increases the potential reward. Yes, it does. But it also raises the risks if it is not managed wisely, and I'll go deeper into that. Sound domestic policy frameworks are essential to maximize growth and to safeguard stability. The second lesson is that benefits are not automatic and they're not permanent. Maintaining them requires a continuous reform movement. But these reforms are not any reform. They have to be tailored and they have to be sequenced in order to deliver benefits for the people, as otherwise the appetite for reforms fades away. So let's have a quick look about the benefits of integrating in a fragmenting world. And I'm not going to go back beyond the Cold War. So during the Cold War, the Iron Curtain fractured the European community. Trade between East and West fell by nearly 50%. And it was like imposing a nearly 50% tariff on any trade going on between the East and the West, leading to immense welfare losses and isolating the Eastern Bloc from global markets. But the transformation since Europe's Eastern enlargement has been nothing short of remarkable, and you've alluded to that. On average, countries that joined the EU in 2004 have nearly doubled their GDP per capita over the past 2 decades. Critically, this was not just about catching up from a low base. Between 2004 and 2019, the EU's new member states saw their GDP per capita grow 32% more than comparable non-European Union countries. The difference was deeper economic integration, and those that were already highly embedded in the regional economy gained the most. You pointed out to Poland, this is a case in point. And while all new members experienced gains, countries with stronger integration into regional value chains recorded nearly 10 percentage point higher GDP per capita growth compared with less integrated peers, regardless, by the way, of geographic proximity. So what was driving that difference? The difference was technology and productivity spillovers. Our research at the ECB shows that a 10% increase in productivity amongst Western EU firms translated into a 5% productivity gain in Central and Eastern European firms linked to those supply chains. So the case for regional integration is pretty clear. And in today's increasingly fragmented geopolitical landscape, it has even become more compelling. So, what does integration actually produce? I would mention 2. Regional integration, first and foremost, underpins growth. European economies are highly open, which means a world splintering into rival blocs poses clear risk to prosperity. And yet, Europe's most important partner in trade is Europe itself. Around 65% of euro area exports go to other European countries, including, for that matter, the UK, Norway, Switzerland. Part of the family. For Ukraine, too, Europe is the principal trading partner, accounting for about 50% of its good trades in 2024. So by deepening economic ties, more closely linking neighboring economies, we can reduce our exposure to external shocks. Rising trade within our region can help offset losses in the global market. So that's the first benefit, underpins growth. The second benefit is that regional integration strengthens resilience. One consequence of geopolitical fragmentation is the realignment of supply chain towards trusted partners. Nearly half of the firms involved in external trade have already revised their strategies or intend to do so, including relocating part of their operations closer to home. And while this trend reduces strategic dependencies, it can also raise costs, moving from a low labor cost region or country back home where possibly the costs are higher. Yet, large integrated regions can mitigate these costs by replicating many of the benefits of globalization, but at the regional level. Supply chains can be reorganized regionally, allowing each country to specialize based on its comparative advantage within regional value chains. And Ukraine stands to benefit significantly from expanding these networks. And the EU stands to benefit from having Ukraine as a partner. So let me give you two practical examples taken from Ukraine's special expertise. The automotive sector. Ukrainian firms already today produce around 7% of all wire harnesses used in EU vehicles. Now, as the automotive industry is now shifting into the electric vehicle dimensions, which require more complex wiring systems, Ukraine's manufacturing base is well positioned to scale up and play a much larger EU role in that value chain. Second example, which will speak to many of you, the drone industry, which has become one of the most advanced in the region, here in Ukraine. Drones are not only a critical component of modern warfare, as you have so expertly demonstrated, but also technology with substantial spillover effects in far-reaching dual-use applications. Indeed, the country's ambition to produce 4.5 million drones by 2025 has accelerated innovation in material sciences, battery technology, 3D printing, just to name three. These advances are already finding civilian applications in sectors such as logistics, agriculture, and emergency response. In sum, for both existing EU members and neighboring countries such as Ukraine, regional integration is both a path to prosperity and an anchor in an increasing fragmented world. Is it all rosy? Easy? Of course not. As we examine the experience of countries that have used regional integration as a platform for growth and reform, we can learn at least two important lessons. And I'll explore those two lessons now. Lesson number one is that if integration is not accompanied by the appropriate reforms, it can create new vulnerabilities, especially in the financial sphere. Financial integration often brings volatile capital inflows, which can make it difficult to distinguish between sustainable growth and unsustainable excesses in real time. Let me mention two ways this can happen. One way is when productivity gains in tradable sectors, such as manufacturing, drive up wages in those sectors, which then spill over into higher wages in non-tradable sectors. What does that produce? It pushes up inflation. This is well documented in economic literature. Now, while this effect is a normal feature of catching up, it can make it very easy to mistake genuine convergence for economic overheating. if foreign capital is in fact driving financial imbalances, such as unsustainable real estate booms, countries may exhibit the same pattern of rising wages and inflation, masking underlying vulnerabilities. That's one symptom. Second one of potential distortion is that capital inflows can significantly affect government fiscal positions by boosting tax revenues and creating the illusion of permanent greater fiscal space. And this often leads to pro-cyclical policies, with government increasing spending or cutting taxes during boom periods, only to face fiscal stress when inflows reverse or growth slows. And these two dynamics that I have just mentioned for you, we have seen them in Europe's recent experience with integration. After the Eastern enlargement, 2004, financial integration accelerated rapidly. Between 2004 and 2008, the new member states experienced an extraordinary surge in capital flows, averaging over 12% of GDP annually, which is twice the typical level of emerging markets globally. Initially, these rapid capital inflows brought clear benefits. It expanded access to credit, it fueled growth, it enabled much-needed development. However, in many countries, foreign capital was disproportionately channeled into consumption and construction booms, while tax revenues rose sharply on the back of property transactions and buoyant domestic demand. And this, unfortunately, led to widespread misallocation of private capital and inefficient public spending. And then the global financial crisis struck. And what happened? Capital flows reversed sharply. Between December 2008 and May 2013, external bank liabilities in non-euro area Central and Eastern European countries declined by an average of 27%, and in some countries it was as down as 50%. So is this a fatality? No. The risk associated with financial integration can actually be avoided. Because we've seen it. Not all countries in the region were affected equally. Those that performed better typically shared two characteristics. One, they had clear policies to channel foreign investment into not consumption, not construction booms, into productive sectors. Strong industrial strategies, skilled workforce, and integration into global supply chains helped direct these investments towards manufacturing and tradable services, sectors that, in turn, drive export growth and are less prone to unsustainable booms and asset bubbles. Second, they maintained robust financial policy frameworks. Tighter capital requirements, active macroprudential measures, and counter-cyclical buffers strengthened domestic banking sectors and curbed excessive mortgage lending. These tools enabled them to absorb large capital inflows without creating destabilizing imbalances. So the lesson is clear. As countries integrate into the regions, as they have, as they will, strong domestic policy frameworks are critical to ensuring that capital inflows support long-term growth rather than generating financial instability or inefficient allocation. I would suggest that this insight is especially relevant for Ukraine today as it charts its path towards recovery. If reconstruction proceeds as planned, the country could attract significant capital inflows over the next decade. But without the right safeguards, that capital risks being misallocated, undermining long-term productivity instead of strengthening it. Now, many of you know that, and there are very encouraging signs that you are learning from what has happened in the last couple of decades nearby. The EU-Ukraine Association Agreement and deep and comprehensive free trade area have already driven significant reforms in the financial sector. Ukraine's banking regulation now aligns with 74% of EU standards, covering critical areas such as capital adequacy, governance, and auditing. The National Bank of Ukraine has adopted a risk-based supervisory model inspired by the ECB single supervisory mechanism, markedly improving oversight. And despite unbelievably challenging circumstances, Ukraine is also modernizing its capital market, consolidating exchanges, upgrading settlement systems, and strengthening regulatory enforcement to attract long-term investors. May I suggest, my dear Andrew, that in that area you might teach us a few lessons, as we may want to follow your path. Now, these reforms that you're conducting are already delivering results. In 2023, Ukraine's banking sector remained profitable and well-capitalized despite the ongoing war, an outcome that would have been unthinkable 10 years ago. We know that progress is essential, especially in fiscal governance. Strengthening public investment management will be critical to ensure that the reconstruction funds are allocated transparently and efficiently. And this is not just about meeting external standards that can be imposed by one institution or the other. It's about ensuring that every euro, every hryvnia delivers real return for the Ukrainian people. Is it a big one-shot effort? That's my second key point. No. Reforms cannot be treated as a one-time effort. They have to be ongoing and sustained, so that the benefits of regional integration are not, because they're not, automatic and permanent and should not be taken for granted. Sustaining them requires continuous reform. And just as importantly, it requires that they be conducted and framed in such a way that the citizens see visible and tangible improvement in their daily lives. And in this context, there are two risks to watch out for. The first is that institutional reform momentum can fade. There is fatigue. It is hard conducting those reforms. And it fades particularly if the economic benefits do not follow quickly. Deeper regional integration typically begins with aligning framework conditions such as the legal systems, regulation, public administration. These areas often improve rapidly. But for the economic gains to materialize, domestic entrepreneurs, households, foreign investors must respond to the new incentives created, and that takes time. In the long run, evidence shows that countries with initially weaker institutions benefit the most from adopting higher standards. But in the short run, if people see only the efforts and not the payoff, not the dividend of their effort, public support for further reforms will weaken, putting long-term convergence at risk. That's the first risk. The second risk is that structural shifts in the economy may weaken the link between integration and economic convergence over time. Let me explain. The integration of goods markets has traditionally driven convergence almost automatically as foreign direct investment flows to the countries with lower land cost, lower labor cost, supply chains relocate, and lower income countries benefit from technology transfers, the spillovers that I was talking about. And this will exist. This will remain an important mechanism even in an era of supply chain reshoring. But countries can no longer rely on that only as much as they did in the past. Future growth in intra-EU trade is expected to depend increasingly not on goods, but on services, particularly digital services. And research shows that service sector activity tends to concentrate in more affluent urban areas that exhibit the hallmark of knowledge economy. Tertiary education rates, strong technology, science sectors that are well developed, and robust digital infrastructure. This means that deeper integration alone will not guarantee broad-based convergence across all regions. Over time, countries will need to invest more in education, more in skills, more in digitalization to ensure that they can build high level of human capital and leverage that under the integration paradigm. Maintaining the path of convergence is therefore not as easy and straightforward as it was before. But slowing down the reforms will not be the answer, especially in a shock-prone world that we face today. Additional point, there is a clear link between strong institutions and economic resilience. Our research indicates that during the pandemic, regions with lower institutional quality experienced, all else equal, an additional GDP per capita decline of around 4 percentage points compared to the top 10 regions with the highest quality of government. So, as our economies are increasingly buffeted by global turbulence, institutional backsliding risks creating a vicious circle. Repeated shocks can undermine economic convergence and further erode public confidence in the reform process. So the best way for countries to sustain reform momentum is to recognize the importance of maintaining public support and, as far as possible, pair governance improvement with a focus on sectors where they have a clear competitive edge, and where deeper integration with the region can unlock significant and rapid growth opportunities. And in this way, the benefits of reform will be felt more quickly and more widely by the citizens. And I contend that Ukraine is well positioned to put this into practice. Its IT sector is already relatively strong. IT services exports reached nearly $7 billion in 2023, making it one of the country's leading export sectors despite the war. And let me here pause for a second and dedicate my remarks to Kolodymyr Soroka, who lost his life in the last 2 days, and he was an IT engineer working for the NBU. May he rest in peace. Ukraine also produces around 130,000 STEM graduates each year, exceeding that of Germany and that of France. And it ranks them among the top 5 countries globally for certified IT professionals. Successful IT clusters are active in several cities, and major foreign firms, including Apple, Microsoft, Boeing, and Siemens, have established their research and development operations in Ukraine. A dynamic defense tech ecosystem is also taking shape, with Ukrainian startups attracting almost $500 million in funding in 2024, surpassing many of their peers across Central and Eastern Europe. Experience from countries like Israel suggests that such a foundation can enable the country to emerge as a broader technology hub in the years ahead. So if Ukraine stays the course on institutional reform and continues to adapt its economy to new opportunities, despite the stormy environment, it can emerge as a vital engine of growth and a key contributor to the region's future. And I agree with you on that, Andrei. So let me conclude. Ukraine stands at a pivotal moment, facing the horrible hardship of war, the challenge of reconstruction, and the opportunity of deeper regional integration. In a world marked by shifting geopolitical realities, such integration offers a clear path to recovery and lasting prosperity. Good for Ukraine, good for Europe. The recent history of regional integration shows not only its immense benefits, but also the importance of managing transitional risks through robust policy frameworks. It also underlines the need to sustain reform over time by ensuring that its benefits are felt by the people. And I'm confident that Europe will be able to fully realize its economic potential, turning the upheaval of today into the foundation of a dynamic future. As Ivan Franko, one of Ukraine's greatest poets, once wrote, "Even though life is but a moment and made up of moments, we carry eternity in our souls." And this enduring spirit captures the resilience and potential of the Ukrainian people and its economy, a spirit that will continue to drive advancement and renewal in the year ahead. Now, you reminded me, Andrei, that I was the first managing director of the IMF to visit Ukraine ever in 2015, that I'm now the first president of the ECB to visit Ukraine in 2025. So I hope it will not take 10 years for me to be the first former president of the ECB to attend as a special guest the Governing Council of the ECB in Kyiv. Thank you very much.
Thank you very much, Madam President, for your compelling and forward-looking address, especially the last sentence.
You will be around.
I hope. You have not only reaffirmed the strategic importance of economic and financial integration in today's fragmented world, but you have also provided a powerful perspective on how regional integration anchored in strong institutions and sustained reforms can serve as a foundation for lasting prosperity and resilience. And that is very relevant for Ukraine nowadays. And of course, we are very grateful for your recognition of Ukraine's progress and its growing role as a partner in the European project, not only as a recipient of support, but as a contributor to more resilient and competitive Europe. And now we would like to open the floor for Q&A session. So we have something like 20 minutes for that. Yeah? And let me use my privilege as the moderator to ask the first question, actually. Madam President, over the past years, you have been one of the most prominent voices in advocating for broader interpretation of central bank mandates, particularly by integrating the green agenda and addressing climate-related risks within the ECB's policy framework. Today, however, geopolitical and defense-related risks now appear to overweight climate risks in terms of urgency and systemic relevance. And in your recent remarks in Berlin, to which actually Governor referred, you have rightly called for a stronger EU defense capability as part of Europe's strategic autonomy. And in this context, let me ask you maybe slightly provocative question. Should we begin to reconsider the mandate of the central banks, including the ECB, to reflect this new reality? Specifically, do you see the case for expanding the ECB's role to account for security-related risks, or at least for embedding strategic security considerations more explicitly in ECB's analytical and policy framework?
Thank you for your question. I'm going to return to the remarks of Andrei, in which he focused in particular on the independence of central banks and how that independence is central to them delivering on their mandate. So there's a trade-off there. And I do think that having a defined mandate, and in our case, as you know, the ECB's mandate is embedded in the treaty and is a single mandate with a primary objective, price stability, and secondary objectives, which is the alignment with the economic policies developed by the other institution. As a trade-off to that mandate, which you might argue is narrowed a bit, is defined in a rather narrow way, the ECB has independence and can determine its monetary policy, provided, of course, that it delivers on its mandate. I think that equilibrium is actually beneficial for the European citizens and for helping us focus on our role, focus on delivering on our mandate, which does not stop us from looking outside the window. You know, this is an expression that was used by Mervyn King, if I recall at the time. You know, don't only look at models, look out the window. And I think we need to do that, and we need to understand what is the policy decided in fiscal terms, what is the policy decided in security terms across the board by those whose responsibility it is, and to take that on board into delivering on our mandate. And I think it's in that context that I pushed, when I started my term in 2011, for the risk of climate change and the risk to the environment to be at least assessed in order to determine whether there was a risk of financial instability as a result, which would jeopardize us delivering on our mandate. So I think a mandate, if it is well understood, and if we are capable of looking outside the window, actually is sufficient and does not need to be modified.
Thank you very much for this comprehensive answer. And now I invite those who wish to ask a question to raise their hand and briefly introduce themselves. And please keep your questions concise so we can hear from as many participants as possible. Please, could you give it the microphone?
Madam President, we have observing like a strategic push from...
Who are you?
Sorry, Volodymyr Lepushinsky. I'm a Director of Monetary Policy Department in the National Bank of Ukraine. So we are observing a strategic push from ECB and from you personally to increase the role of euro. And it's quite particular momentum for that, because now there is global search for currency diversification. But as you clearly described in your columns and speeches, there are structural limitations for that. And Europe needs to overcome them. And actually our speaker, guest speaker for tomorrow, he as well, Kenneth Rogov, he as well admitted the structural problems. So how do you assess the probability to overcome these structural limitations in the short run, in the long run? And if yes, how next wave of EU enlargement could help to overcome these limitations, including like integration of Ukraine?
Thank you, great question. And I'm sure that Ken will draw on his latest book to argue the transformation that we are seeing, which are actually demonstrated even by market moves. But let me turn to the role of the euro and what I call the three pillars. On the role of the euro, I would argue that, first of all, it has maintained its role as a reserve currency for central banks. It is, you know, around 20% roughly. It hasn't budged much. And it has recovered from a previous downside that it experienced a few years back. But it's roughly at 20%. While in the meantime, and it is the second largest reserve currency in the world, if you exclude gold, which has significantly increased in value and also in volume held by central banks, given the current uncertainties. But the other clear prime reserve currency is the dollar, whose role as a reserve currency for central banks has actually slightly diminished over the course of time. It is now about 58% of the central bank reserves, and, you know, future will tell. But I'm not suggesting that this is going to change overnight at all. What I tried to do in my recent speech that Mr. Governor, you referred to, that I call my Berlin speech, I tried to articulate what are the prerequisites for any currency to gain international reserve status. And I think that there are three. The first one is geopolitical, the second is economic, and the third is legal. So on the geopolitical front, I think the country that aspires to that role needs to demonstrate that it is a trading partner. And I would observe on that page that Europe has 72 bilateral trade agreements with countries around the world, and that it covers about 40% of international trade. Is it enough? Should it be more? There is a clear desire and strategy on the part of the Commission to expand that number of bilateral trade agreements. This is not enough. As I argued, it has to be supported by reliability, which itself is often defined as the might and the capacity to defend oneself. Again, on that front, there are efforts underway by countries, Germany is a case in point, and by Europe at large. The second element which is necessary is the economic strength. And for that, clearly, you need to be a territory which is attractive to investors. You need to have reliable fiscal policies, you need to have a good equilibrium, if you will, but you also need to be able to bring capital at the table. And that's where I was saying in my speech earlier that we can learn from Ukraine. You are reforming your capital markets deeply and significantly. We have to do the same, and probably more, because we are starting from a base of 27 different territory. But I would observe again that the Commission, the European Council, the Parliament are aligned in trying to push, and I hope fast, in that direction. It's badly needed. The third component, which I think we have, sometimes we complain about it, but I think that its value comes from the risk of missing it, and that is the legal trust and confidence that economic actors have in Europe. The fact that we respect the rule of law, the fact that whether we like it or not sometimes, we will abide by the rules of the International Monetary Order, for instance, and that when we sign a contract, that contract is honored and adjudicated properly in front of our courts. So those are the three pillars that, you know, would be necessary for any currency to aspire legitimately to that enhanced role, and I hope we move in that direction, not with a view to unsettle anyone, you know, this is not the point, but with a view to strengthening the architecture that was built under the Jean Monnet, whose quote I have not mentioned because it would have been a bit too much today.
Thank you.
Thank you, please.
There's a hand there, hand there. The lady has to.
Hi, thank you very much, Madam. My name is Hannah. I'm fresh graduate from University of Michigan, PhD program. Thank you very much for your encouraging presentation. I would like to circle back again, as everyone here, to speech by Mr. Governor. about the role of central bank in dealing with populism. As we can see in the US, despite robust consumption growth, moderation in inflation, a very good labor market, voters feel that they have to support the policy that would make the job of central bank really hard. So they don't feel satisfied. And as populism, the power of it is that it reaches back to every person and their feelings. Do you think that central bank communications have the room to reaching out this sentiment, switching a little bit of its communication to the ordinary citizens and trying to combat this populism and communicate the benefits and the economic situation to people?
It's a really good question that you ask. What can communication do to help central banks explain that they're here for good? And that what they do is not necessarily popular, not intended to be popular, but is intended to serve the people and give economic certainty and stability for those who want to invest, who want to hire, who want to manage their assets. And I'll give you my personal take on this, because it's a topic which has many literature and authors about, and where multiple views are taken. But I will talk to you from what I have experienced. It is hard to communicate with the citizens, because the communication of a central bank is generally targeted towards a particular audience of those who observe markets, of those who trade on markets, and of those who comment on market operations, essentially. And as a result of that, there is a very coded language, I would call it a very specific jargon, where any word is loaded with prior history, where the facial expression is analyzed and dissected, where the tone of your voice can be sort of streamed in order to determine whether you're more likely towards the hawks or more likely towards the dove, whether you're signaling the imminence of a rate cut or a rate hikes, where the color of your clothes are going to mean something. And that's a very small category of experts. If you want to talk to a much larger public, you have to sort of use normal words and not the jargonic language. And then the experts will say, nah, this is not appropriate. But at that point, I think that it is the job of a central bank and its representatives to ignore a little bit that skepticism and contempt in order to talk to the people. Because if we believe that inflation expectations are a key driver, then there are multiple layers of expectations. There's the market expectations, there is the analyst expectations, but more importantly, there is the consumer's expectations. And by consumers, I mean both households and corporates. And for them to appreciate what you're trying to do when you're trying to tame inflation, to bring it to the stability that you have defined, you have to use much more normal language. It's hard. It's absolutely hard. We also need to use the medias that will actually carry your message. So we cannot just simply stay with our, sort of traditional statements. We need to translate that into different expressions so that it carries to a much larger public. I hope I've dealt with your question.
Thank you very much.
Thank you very much. And David, please.
Can I? Yeah. My name is David Vavra. I'm managing partner of OG Research, a consultancy in central banking, and I have, if I may, President Lagarde, I have two related questions, if I may.
You remind me of my press conferences. They all stand up and they say, I have two questions.
Two questions. They are related by decision-making.
Okay.
You are publicly calling for reform of the decision-making processes in the European Union, in particular you're a proponent of a shift from the unanimity to qualified majority voting on more issues. I think most recently, it was in your Financial Times article, I think 2 days ago, when you called for a stronger role of euro as the global currency. Again, you repeated the same call. And I cannot agree more, because I do believe that the endless consensus seeking is probably crippling our ability to be agile and to react in the face of the shocks that we are seeing right now. But what do you see, what do you think are specific steps or pathways how we could get there in political terms? So that's the first question. And the second one is more about the ECB decision-making processes. Now, the model of decision-making in the ECB is one based on consensus. And that has understandable roots. At the beginning, understandably, ECB wanted to represent everyone in the EU and not any particular state, any particular that could be represented by individual voting systems. But isn't it time to reconsider? Isn't it time where a more majority voting at ECB could make the institution stronger going forward? What's your view? Thank you.
Well, thank you so much for both. And both deal with actual governance and best expression of the views and the strategy and the goals. On the first one, I say, and I will continue to say that a different governance will be required, and that having so many topics that are governed by unanimous agreement is an impediment to implementing the strategy. You say it's crippling. I think eventually, laboriously, there are ways that are found over the course of time to not be crippled, but it is laborious, and it is time-consuming, and it is energy-consuming. So I don't know exactly what, in terms of constitutional reform, governance reform, can be achieved. But I would suggest that, number one, intergovernmental agreements are one option that exists. I would suggest that, for qualified majority to become the rule in a number of sectors will probably, but I'm not, I'm not the expert in that field, but if it requires treaty change, then that should be considered. Now, if the treaty change is itself subject to a unanimous agreement, it will prove difficult, but it's not impossible. There are things that, we thought were impossible until they became possible, as Mandela would have said. So those are, two possible avenues. On the governing council of the Eurosystem, things do not happen only by consensus. I can assure you that I have commented on decisions that were made by a large majority, but where we had dissent and where a minority of the governing council members were not supporting the decision. I've been lucky that this was rarely the case, but it has happened in my last 6 years in the job, and I have not shied away from that, including by sometimes saying who has disagreed with the majority views. I think in the main, the way in which decisions are progressed leads to a much larger majority and quite often consensus. Because we want to convey the view that monetary policy is decided by the entire group and applies in 27 different member states, which each have their respective fiscal authority. And to be able to deliver on that unity, however difficult sometimes it is, because you have to convince and you have to work hard and you have to provide more data, I think is delivering an added value. You will see Andrew Bailey tomorrow, I'm sure, and he will be able to explain to you the virtue of having so many in favor, so many against, so many abstain. But we're talking about a different territory with one single fiscal, single language, and the factor of unity that is delivered by consensus or very large majority is in and of itself, I think, a bonus.
Thank you.
Thank you very much. Unfortunately, we are running out of time, and probably let's take the last question. And can you pass the microphone to Vladislav?
Oh, my good friend.
Hi, Madame Lagarde. Vladislav Rashkovan, IMF. 6 years ago, my daughter Sonia was shadowing you and the board of when you were the managing director of IMF.
Yeah.
She sent you best regards. Here we have a lot
reciprocated.
Here we have a lot of young students and young people. What would be 2 free advices which you could give to them that, like in 20 years, to be able to become not only the governors of the National Bank of Ukraine, but also maybe the ECB president. Especially this is in this kind of world which is fragmenting, but also is developing with artificial intelligence. What would you advise them to look at and what to study? Thanks.
I have fond memories of your daughter, so pass on my warm regards. I would say to those young people in the room, number one, don't give up. Don't give up and keep at it. I was a synchronized swimmer on the national team of France, and sometimes it was just bloody hard, and we failed. And the coach used to say, "Grit your teeth and smile." And I think it's, at that time I didn't understand really what she meant, but over the course of time, I came to realize what it is. In the face of adversity, and God knows how much adversity you face, grit your teeth and smile means I challenge you because I will overcome the difficulty that we are facing. So number one, don't give up, grit your teeth, smile, and work as hard as you can in any field where you feel that you are going to achieve yourself and your talent and your competence. And you have abundance of that. So don't restrict to a particular field. Open the horizon. Open the number of languages that your brain can manage, because that will help you in any configuration doing so. And about that, Slava Ukraini.
Thank you very much. That was, from my point of view, the perfect ending of this terrific talk. And thank you once again for coming and for making it possible. Thank you.
Thank you. Thank you, Madam President. Mr. Deputy Governor, this round of applause is for this really great conversation. And now I think after this intensive part, we need a small break. So 30 minutes for refreshing, and please be in time at 12 o'clock. We will continue. promised to offer insightful perspectives and practical recommendations. While I make this little introduction, I hope you will take your seats and we will really start it. So the topic of the first panel discussion is EU enlargement implications for the financial sector, peer learning for a better future. This panel will look at the many ways EU affect the financial sectors of both member states and the candidate countries. Our panelists will reflect on peer learning experience from current member states, discuss how central bank independence is evolving, and consider the unique challenges and opportunities of countries like Ukraine while they move forward to the EU membership. We expect an open and forward-looking conversation that combines technical insights with personal experience. So I give the floor to Professor Stefan Ingves, Chair of Toronto Centre's Board of Directors, who will present the panelists and moderate the panel. So, Mr. Ingves, please, the floor is yours.
Let me start by saying that it's truly an honor for me to have the privilege to chair this panel and to participate in this conference. After 30 years in central banking, I certainly could start out this panel by speaking central bankese and mumble the usual things about inflation targeting and all the rest of it. But I'm not going to do that. I'm actually decided to choose a completely different starting point. And let me start by going more than 100 years back in time. My great-grandfather refused to send Finnish conscripts to the Russian army. My grandfather, he had to fight. And my father also had to fight, and all my uncles had to fight. I did not have to fight, and maybe that is just a twist of history. Now, you fight for your freedom, but you also actually de facto fight for us. And that is a brave and it's a very honorable thing to do. So for the rest of us who have come traveling to Kiev, you really, really deserve our support. Now, with that as a starting point, let's move over to the topic here, talking about EU accession and what that might or might not imply when it comes to the financial sector. And let me first start by asking Governor Pishny, my good friend and earlier colleague, to come up on the podium. And also Vitas Vasilauskas, who now is the executive director of the IMF, of the Nordic-Baltic chair at the IMF. And Sergei Marchenko, the finance minister. These individuals really do not need more of a presentation. And then we will also have with us Jacek Jarzewski, my apologies for my pronunciation, from the Polish FSA, and he will be joining us online. So with that, and given that we have limited time and without further ado, please come up on the stage and we will get going. We will start with 10 minutes per person to give their personal remarks on the whole topic of financial sector and EU accession. And then we will discuss a short while among ourselves, and then it's open for the floor to ask whatever questions that you find interesting to ask. So, Governor, I'll ask you to start out with your reflections, Andre, on what's next when it comes to doing this. A few of us have been through this accession process in the past, and you are heading into it, and we're keen to hear your introductory remarks and reflections on this. So the floor is yours.
Дочекалися, Сергія. Вітаю, пане міністр. Ви знаєте, я хотів би насамперед скористатися ще раз можливістю і більш так, я б сказав, усвідомлено подякувати усім, хто сьогодні приєднався до нас. В Україні сьогодні відбувається важлива розмова.
We have an important conversation. To a certain extent, it's a part of contribution of the National Bank of Ukraine to promotion of a very important and strategic process for our homeland, European integration. But we want to demonstrate this process from the point of view of mutual challenges and benefits that will be received by the European Union, to which Ukraine aims to be included. And around this, there will be probably the most substantiated discussions. Ukrainians, I can see it at the level of cooperation we have with the government. I see it at the level of deep involvement of the NBU team, how much we are interested to have this process as dynamic as possible. We were awaiting for European integration for a long time. EU accession is the way for Ukraine, the way of challenges. This is something, the threat for European future of Ukraine, in fact, triggered the revolution of dignity, because people went to the streets. The willingness of our enemy to destroy us is because we see our future in the European Union, and we pay a very high price for this. And we want this conversation to be very substantiated. We want the cooperation around this process to be efficient for us and for our partners, and we will not hide the slightest issues of our cooperation. When we are saying don't be afraid of competition from Ukrainian producers and Ukrainian financial sector, we are explaining this not only by our requests. We are not asking for any concessions. We are aiming for the conversation with understanding on which it is based and which mutual benefits it can bring. And the last reflection before I give the floor to my colleagues. I really like the discussion which is now held in the European Union that feels it needs energy, the energy that will fill the world accession or integration, not just a political motto, but as a model of development, model of survival, model that will direct the European Union to true, strong, powerful, strategic autonomy. And the discussion is around this. And I'm very pleased to see that our colleagues from central banks take part in this conversation. The level of expertise we have, the understanding of economic processes, the fact that we are now addressing not that much the consequences but the form factors. We are working not only in the conditions that were created for us. We are trying to discuss topics that impact today, how these preconditions will be, what these preconditions will be. And this is the right direction in which the development is going on now, and probably revision of the depth of the central bank mandate is part of this conversation. And I am convinced that this conversation is useful both for Ukraine that hosts the conference and for all its participants.
Thank you for those words, Governor Prishny. And now over to Vitas, because you have done this before. and we have also been in the same business, both of us, for quite some time, and we have some quite exciting memories that I'm not going to talk about today when it comes to dealing with financial crisis, but that's a different conference. Please.
Thank you, Stefan. And of course, I will start by thanking Governor Yu, your team, and other organizers, for possibility, to be here with you, and really, it's big honor. So I will start with my introductory remarks. I have several slides, of course. I will not long, so, but yeah. So from a personal perspective, in 2004, when we became members of the EU, I was responsible for the taxation chapter at the Ministry of Finance. At that time, I used to work at the Ministry of Finance, and I saw those negotiation process from inside, So, and I can say that at that time at the Ministry of Finance, we used negotiations just for pushing some structural reforms needed, domestically structural reforms needed, in the country, because in discussions with politicians, the EU as an example helps a lot, and you can just use negotiations as some kind of, I would say, of vehicle. So I will start from a little bit longer perspective. So personally, I am a big fan of EU integration. In EU, we can see two big camps of the integration. One is, I call them confederation approach, and the other camp is more on let's say federation approach, So, and I think that fully integrated EU, only fully integrated EU could compete globally and realize in action, not on paper, those freedoms which are written in the EU treaty. So probably, as you know, Lithuania was one of 10 new EU members joined in 2004, and of course that was more than 20 years ago. From historical perspective, 20 years for Europe, I would say, mean nothing. But for my country, from Lithuanian perspective, 20 years are very meaningful, as the Second Republic of Lithuania was restored just 35 years ago, so on March 11, 1990. So, what I can tell you about the EU accession and the impact to Lithuanian development. So personally, I think that membership was the best move for a transitional economy country from the economic, political, legal, business, ethics, and corporate culture perspective. It was a decisive step for us legally, economically, and politically, and I think it finally returned us to the Western world where we always have been, but of course we had some kind of a break of 50 years. So, and the current stage of development in Lithuania is characterized as the second golden age. The first one was taking place very long time ago, so it was in the 16th century. And we know from history that after a period of prosperity, a country starts to stagnate. And we cannot ignore history, as history teaches us a lot. And based on that, I think small open economies always should be prepared for external, internal shocks, and must focus their vision, I would say, their view just to the horizon, to more visible horizon. And I would like to share with you several, let's say, figures, and I think during your governor introductory remarks and Madam President's remarks, it was also mentioned what a membership means for let's say new EU countries. So and I just in this table, in this slide, I just showed you four main figures: GDP per capita, minimal monthly wage, and average monthly wage. So before the EU membership and 20 years after the EU membership. So and you can, as you can see, those figures illustrate growth not in, let's say, percentage points, but through times. And of course, the economic development path has been not always even and positive. Of course, we can remember 2009, just after the global financial crisis, where Lithuania's GDP dropped by almost 15%. Of course, that meant a need for implementation of, let's say, consolidation measures. That was implemented. Of course, it had political costs for government at that time. But economy started to grow again, and it continues to grow. Of course, not everything has been rosy in Lithuania since the EU membership, as we still face structural income inequality problems. Of course, we have, I would say, big differences between cities and rural regions. And of course, there is a need for structural reforms, especially in education, in the health area. But no, those problems are not only typical for us, but also for other countries too. So speaking about the EU membership, we should not forget that EU is not only an economic, but also a monetary union. And meaning that every EU country, except those who has some legal clause, they are obliged to introduce the euro. So in our case, we had from beginning, from EU membership, we had very clear strategy. So we wanted to end as the euro country. So we switched our domestic currency to the euro in 2002, so 2 years before membership. And of course we fixed our exchange rate. We tried to adopt euro first time in 2007. It was not a very successful attempt. We failed. The legal reason was we missed the inflation target by 0.1. But real reasons were related with fundamentals of our economy. We were not prepared. So, I can only thank for people, decision makers at that time, that we were not allowed to introduce euro. And I think 2009 crisis showed us very well that we were not prepared, that our fundamentals were weak, But then of course, we took time, we prepared, and then of course, we introduced euro in 2015. Before we made cost-benefit analysis of euro introduction, we had big discussions with society, because the euro wasn't popular at the beginning of campaign. the popularity of euro was only 37%. But before euro introduction, the society changed the views, so and we entered in the eurozone with around 60% of support. Turning back to the financial sector and the EU membership. The main topic of interaction was related to credit growth, because EU accession boosted credit, not only from the demand side, but also from the supply side. With EU membership in 2004, the financial cycle started to grow rapidly, jumping up its peak in 2007, 2008, as you can see, and with EU membership, as I say, and as many in Lithuania now say, the party started. And the party started not only for households and businesses, but for lenders. Most of them, of course, most of lenders are banks as well. The main reason for such behavior of credit takers and credit providers were related to the increased positive sentiment and lack, I would say, absence of macroprudential policy tools. Because in our case, borrower-orientated guidelines for responsible lending were introduced only in 2011. The other characteristic of the Lithuanian financial sector is that, of course, it is banking-oriented, and our banking sector is quite, I would say, concentrated. And it's more concentrated than EU average. And you can see it from this slide. Of course, banking sector is profitable. Of course, it is efficient. Of course, it is resilient. But what regards concentration, of course, there is a way just where we could to improve. And I think EU membership could help it. Because when you enter the EU, you just broaden your market. So now you are not only in the Lithuanian market or in Ukraine's market, so because your market becomes the EU market. But of course, under one circumstances, small circumstances, that EU market functions and functions well. What regards the financial services market in the EU, still it is fragmented, and still there is a need for, let's say, improvement. We are talking more than 10 years about banking union. We are talking more than 10 years about financial markets union. Of course, we have those new reports, what we have spoken about in the beginning of this conference. Let's hope that all those measures, all initiatives from Commission side will be implemented, and that we will join the real financial service market. And I will end by noting that the EU membership journey is a marathon, not a sprint. The membership process requires repeated and permanent efforts, but when a marathon runner crosses the finish line, the result is always good, it's always positive, and it pays off. And my very final point would be that EU enlargement is not a one-way process. It is a two-way street, as there are two winners, the new member state and the union as such. Thank you. Thank you very much.
Thank you, Vitas, for those words and a very nice introduction to what you went through. And let me stress that exactly what you said, that it's both a marathon and a sprint. Because from time to time you actually have to sprint a bit in order to make these things happen. But actually it is forever. it goes on forever. And the first time I came across EU accession issues was actually, but maybe it says more about my age, was back in 1985. But eventually, once you have joined in one form or the other, that doesn't mean that things stop. Then you just become a member of the family and then you continue that conversation. Now over to Minister Marchenko, and floor is yours. Please let us hear what your thoughts and reflections are when it comes to where you are heading and what's next.
Thank you, Stefan. Let me speak Ukrainian because auditorium is Ukrainian predominantly, and I would like to speak Ukrainian. По-перше, хочу подякувати Національному банку України за організацію такої важливої події, конференції. Це вже чергове така подія. Цього разу вона залучила досить серйозне коло учасників
a serious circle of participants with large experience and prominent features recognized at the international stage. Thank you for letting me join this conference and sharing our perspective from the point of view of the Ministry of Finances, the perspective of the European integration and our efforts in this regard.
Я хочу сказати, що досить цікаві були слайди у Вітаса.
Of Vitas were quite interesting and illustrative. They demonstrated how much the perspective of the European integration allows expecting for the perspective of economic growth and improvement of citizens' life level. We are discussing that from the point of view of financial integration. So this experience is financial, it's quite important. And it is one of the examples allowing us to understand why and with which purpose we are struggling to integrate our financial system into the system of the European Union. From the point of view of the governmental efforts, we have a plan. We have Ukrainian plans that the Ministry of Economy has developed jointly with the European Commission, and this plan envisages a series of steps that would approximate us to the European Union. We implement the required legislation, and in terms of financial sector, there are very serious events and activities that allow us claiming that we fulfill the European directives, including the legislative requirements, implementing the laws that are necessary to get into the European Union. I would like to dwell upon the draft law on the uniting into the unified euro environment, which we work together with the NBU and with other members. That is a joint project, and this draft law is currently being considered by the Verkhovna Rada, Supreme Council of Ukraine. Despite the rather complicated process and some issues are quite spur a lot of discussions, I still believe that if we want to have a possibility to conduct payments in euro, we need to adopt this law as quick as possible. There is no other choice for us. First of all, that's our obligation. Secondly, this is European directive. And third, it will let us adapt our payments to the Eurozone as fast as possible. Which benefits are provided by this draft law for businesses, for citizens, and for the state? Firstly, it simplifies settlements in euro. There will be no need to open separate bank accounts in third countries. You will be able to make these payments from Ukraine. Secondly, instead of several days of settlements, it will require just seconds. Third, the commissions that are now working, are now applicable up to 15.25 euro. Those are double commissions that we now have to pay in order to make these payments. These payments will be done as fast as possible without any commissions.
Thirdly, it creates benefits for businesses in terms of their interaction with other countries' businesses. Business payments will be done very fast and comfortable. It is also a good perspective for the citizens, for those who don't have any issues with the law. It will be possible for them to demonstrate their accounts and to demonstrate that they can pay to any country of the EU. That's a great perspective for them. Of course, there are certain discussions related to the register of accounts, register of cells, and other events that are of discussion today. We need to trot this path and understand that if we want to be transparent and make payments in the EU, in the Eurozone, we need to do that, and that is our path that must lead us definitely towards there. I'd like to also to mention, now we're discussing quite complicated draft laws that require certain time to bring it through the parliament, but I expect to be done quite quickly. In terms of financial monitoring, this will allow us to have the register of final beneficiary owners. That's also another part of this draft law. And the last one, not to burden you with the complicated banking terminology. You said this is a very specific draft law for the Ministry of Financing, in particular for the banks, for settlements. It was necessary to adopt this draft law for us long ago, because our neighbors, in particular Moldova, Serbia, have done that already. And they have obtained the path for payments in the Eurozone. We need to trot this path if we want to meet the criteria of the EU countries and to do all the necessary steps to be an appropriate member of the EU. And the benefits, well, I hope that at the previous slide you have seen them, and I believe that we can expect not a smaller perspective from the overall EU integration and from the perspective of this integration. Thank you.
Thank you. Thank you for those remarks. And it also sort of shows all of us that it's one thing to talk about these things in a very kind of general level, or maybe at the super macro level. But at the end of the day, you actually have to get down into the plumbing in order to make things work. And this is absolutely necessary in terms of doing the plumbing. And most people actually very often do not focus on these things at all, and they think that it happens overnight, but it doesn't. So congratulations if you start digging into the plumbing and getting the plumbing right, because that's a necessary condition, but not a sufficient condition when it comes to EU accession in one form or the other. Thank you for that. Now over to Jacek Jarzembski, and you are joining us online. Floor is yours.
Good afternoon, ladies and gentlemen, even though it's still probably morning. So first of all, let me say that even though I'm on this panel individually, I'm accompanied here by my deputy, Marcin Mikołajczyk, who is in charge of the banking supervision, and my head of international cooperation, Damian Jaworski, who are also very much involved in the cooperation with our Ukrainian counterparts. And please also allow me to make a personal comment, because I very much regret not being in Kiev with you. I very much hoped to be with you in Kiev today, shaking hands with Governor Andriy Pyshny from the National Bank of Ukraine, with Deputy Governor Dmitry Olejnik, who is our direct counterpart responsible for banking supervision, and all the other NBU board members and all the other distinguished guests and NBU team members. Unfortunately, we are connecting remotely from Warsaw today, but I very much hope to be able to come and visit you and shake hands and meet you in person and have a direct exchange as soon as possible. Also, one comment that I wanted to make is that during our last visit
to Kiev last December, we are indeed struck by the resilience and the resourcefulness of Ukrainian people in the streets of Kiev. Even the situation was very difficult, even the challenges were enormous. We could still see smiles on the faces of the people in the streets. We could see the unwavering optimism and unwavering willingness to continue with normal life. And all these memories that we have brought from Kiev last December, they make it even more painful and heartbreaking to hear about the recent casualties that are the effects of the airstrikes that Ukraine is suffering right now. And I also want to stress it very, very strongly that our authority, the PFSA, but also me personally, we remain fully committed to be working as close as possible with our Ukrainian friends and colleagues on matters related to operational resilience of the financial sector, on discussing together how we can think about modernizing the legal framework for the financial market in Ukraine to make it align with the best practices in the European Union, and also how to assist and help Ukraine with all the other membership preparations. One of the examples that I would like to mention here is our ongoing twinning project that we are conducting together with our colleagues from Spain and Lithuania in cooperation with the NBU on the supervision of non-bank entities. And I very much believe that, and I fully agree with Governor Andriy Pyshny on this point, that I fully believe that a free, democratic and strong Ukraine at the heart of Europe will make all of us stronger. And I also very much believe in what Andriy Pyshny said before, that we should very much consider the integration of Ukraine with the European Union as an opportunity, not a threat. I'm fully aligned on this. There is a saying that will summarize this part of my contribution to the panel. It's attributed to one of the Greek storytellers, and it says that united we stand, divided we fall. So I believe that reflects the approach that we'd like to follow in our cooperation with our Ukrainian friends and colleagues. And moving to the question that was raised by Mr. Ingves in connection with the topic of the panel. First, maybe let me follow a bit the steps of Vitas and say something about the Polish economy, because we have also the feeling that we are living a second golden age of Poland right now. A few weeks ago, The Economist magazine published an issue with a cover headline, "The Remarkable Rise of Poland." Let me just give you a couple of numbers showing the Polish path or the Polish experience. Starting from 1990 up until today, the changes in the PPP adjusted per capita GDP were really enormous. So in 1990, just to give you an example, Polish PPP adjusted GDP per capita was roughly at the level of 35% of this of France. Now we are reaching the level of roughly 80%. Also, the quality of life, the life expectancy, the human capital indices, they have skyrocketed after 1990, and we believe that we are a clear beneficiary of this is a clear benefit, clear outcome of our integration with the EU and of our economy becoming a part of the open economy. What are the reasons behind the success of Polish economy? Let me refer to the writings of the recent Nobel Prize winners in economics, and I mean Mr. Acemoglu, Professor Acemoglu and Professor Robinson, who have received the Nobel Prize in economics in 2024 for their book about the so-called narrow corridor, because they actually list Poland as one of the examples of the countries that were able to enter the narrow corridor and to stay within the narrow corridor. And what is the concept of the narrow corridor? Basically, the concept that says that in order to be a successful economy, you have to combine a strong state with a strong society. A strong state is necessary to enforce laws, to ensure a level playing field, to prevent crime, to prevent fraud, and to ensure public services that are vital for the quality of life and that also for attraction of human capital. And this strong society is necessary to control the strong state. So if we have a strong state without a strong society, it may turn into a despotia. If we have a strong society without a strong state, it may turn into an anarchy. So what is between is the narrow corridor that we need to follow in order to be successful as an economy. And actually Poland, we believe, has entered this narrow corridor in 1990, and we staying within the narrow corridor. And our EU accession was also a significant step in allowing us to stay into the corridor within this corridor. So, if I were to mention, of course, a very concise matter, the most important lessons that we believe that we can draw from the Polish experience and that can be useful for our Ukrainian friends. First of all, build a strong and effective state. So that's part of the narrow corridor concept. But on the other hand, the second one, foster development of the civil society. So build a strong society that will be able to control the strong state. Third point, I would say, integrate your economy with the global one, and in particular with the European one, because we are clearly a beneficiary of the open economy. If you look at the figures for Polish exports after the EU accession, that's clearly a driving force behind our growth trajectory. And the fourth lesson I would mention is be not afraid of market reforms. So that would be the golden four, if I were to mention just 4 points, but also with one important caveat. Do not mechanically or automatically copy solutions from other countries, because what might have worked in other markets may not necessarily be the best option for your market. So the fifth, let's say, lesson on top of the four that I mentioned before was be innovative in crafting your own solutions, and not only be innovative, but also be brave, be courageous to come up with your own solutions that you believe will be fitting your market best. Of course, in line with the general spirit, with the general lines of what we, as our civilization, consider to be the best practices. And one more important point that I would like to make here, which also goes back to the conclusion that was made either by Vitas or by Stefan, I'm not really sure who of the two gentlemen, my co-panelists, mentioned that EU accession is a two-way road, in a sense that the joining states or the new member states or the candidate states, they learn from the Union, but also the Union learns from the candidate states. And I think this is particularly true given in the context of the Ukrainian accession effort, especially if you look at the remarkable resilience of the Ukrainian not only financial system but the entire economy, the entire society. I believe the way how Ukraine, as a country, as a society, as an economy, is able to resist Russia's unjust aggression, this is truly something that we should be learning from. And I believe that the entire West, and in particular Poland, but also the institution that I have the pleasure to represent, which is the Polish Financial Supervision, we can learn a lot from our Ukrainian friends, and we are keen on working with you also about your experience and about talking about the lessons that we can learn from your experience. So maybe just one or maybe a couple of additional topics on Ukraine. It was well noted today, including in the very inspiring, insightful keynote speech by Madam President Lagarde, that we also note the remarkable success of Ukraine in terms of reforming the banking sector, introducing changes that are always difficult, but for an economy which is at war, they are even more difficult, and it's probably a different reality than having to implement all these changes in a situation of peace, of time of peace. So I must say that you have really done a lot. And just to mention some of the examples, of course, the central counterparty, which is responsible for clearing the transactions, the AML, CFT compliance matters, and matters related to enforcing of those questions related to governance of banks, to NPLs. I'm not even trying to mention everything, because these achievements can be found, of course, in the documents that are published by the IMF in connection with the IMF's reviews on Ukrainian financial system. But as a fellow supervisor, as a colleague, and I also believe a friend of Ukraine, I would like very much congratulate you on what you have achieved in this respect, especially that the conditions under which you are achieving all this success are extraordinary. So it does require absolute praise. One thing that I would like to mention, of course, in this context, is that we've gone through a process of our harmonization with the acquis communautaire some 20 years ago, a bit more than 20 years ago, and even I think it's clear that even for an economy, for a country which is not at war, it's always a very significant challenge. For an economy which is suffering all the acute constraints of wartime, I can imagine that the prioritization is key, and probably this is the lesson, or this is the topic that may be may be worth discussing in our future conversations. How to prioritize the alignment with the acquis communautaire, because we believe that both sides should have a very pragmatic and flexible approach on this point. So maybe we should agree that Ukraine, of course, should aim for having the best regulations, the best solutions in all the fields of the financial market, but probably there are priorities to be set, including operational resilience, including governance, including, of course, the topic that we'll be talking later, independence of supervision, because I know that we'll be probably touching the topic upon also later. But I also believe that we should be pragmatic in saying that maybe at some point in time we should say that Ukraine should just have good enough regulations, not aiming for having everything at the top level at the very first day zero, because we understand that you are suffering acute constraints because of the war effort that's shaping the entire economic life of Ukraine. Just as probably I would conclude my, let's say, introductory round of comments here. What I would like to once again declare is that we as the PFSA offer all the support that our Ukrainian friends and colleagues would like to hear, to see from us in this context, and I very much with you, Andrei, on this point that we should consider our integration as an opportunity. Thank you very much.
Thank you for to Governor Prishny. What do you think will be the most important transformation that you have to go through over the coming years going through this process?
Насамперед я хочу подякувати усім колегам за абсолютно неймовірні з точки зору корисності поради. Ваш досвід є безцінним для України. Він одночасно свідчить про декілька важливих моментів, які кажуть про те, що інтеграція до Європейського Союзу – це обопільний рух. Рух назустріч одне одному. Водночас,
at the same time, you very clearly outline the preconditions subject to which this movement can be successful. EU accession is a territory which is filled with challenges. And it depends on us and our EU partners what will be at the end of this way. Will there be any benefits? What kind of benefits will be? Whether they will meet the expectations of the society. And we have to lead the society, through quite a difficult road, using complex navigation on this way of reforms. I want to thank Sergei on how truly, as a finance minister, he cares about all the issues that matter in each step of on our way to EU accession and inclusion of Ukraine to SEPA. I can evidence that our cooperation in implementation of reforms and commitments undertaken under the IMF program, it's just an evidence of this cooperation. And at the same time, it is an evidence that in the EU accession process, there is not one winner, NBU or the Minister of Finance or the government, same as there is no single winner. It's our joint result. And this synergy of efforts allows us today to talk about much more ambitious time frame that was than the one was demonstrated by the countries in the wages of enlargement of 2007. We don't have 10 years. We simply don't have these 10 years. And therefore, the issue of looking for optimal navigation, how to lead the society through these complex reforms should be as efficient as possible. The issues of sustainable development of the society as a precondition and even a safeguard. The issue of strong state that should generate political will and have some safeguards, very efficient against populism, to be responsible for the adoption of political decisions. Christine Lagarde mentioned something which is a very key phrase in my opinion. And if we take into consideration that we heard it from the president of the ECB, a very technocratic organization, it seems to me that we have to pay very special attention to it. She said, don't look at the models, look through the window. You should consider how people perceive your reforms, because people are sources of political will and force and inquiry, and they will assess whether your progress and EU integration are efficient. They have to understand why they have to wait, because the process of EU accession talks is not an easy exercise. And I fully agree with our Polish colleagues that, in fact, this is the model we are looking for. We don't want mechanical copying. We want smart regulation. We want to have smart architecture. We want, knowledgeable decisions. And I think we have the right to it. And in fact, we have the inquiry for this, even from our EU partners who are now looking for the source of strength. And EU accession to the European Union may trigger both deregulation and competition and market growth and regional integration, all the things we are discussing today. This is really important. The experience our colleagues demonstrated, colleagues from Baltic countries, from Poland, it evidences and proves that we can be successful. We can find that narrow corridor. But we should not only find this narrow corridor, we have to protect it, because the war continues, and this is the context that we can't avoid, and we have to move in this narrow corridor very quickly. The history pace is accelerating already. Accelerated. Uncertainty prevails as a factor. Uncertainty. Can you recall anything like this? When it is transformed in this system of priorities into brave and bold decisions, it's a window of opportunities. And we understand very well what we need to do, because the National Bank, from its side, has not stopped for a second in the process of EU integration. Our equivalency rate is now 75 to 77%, and we intend to implement all key regulations by 2027. We undertake this commitment, and I know that our colleagues from the government have the same intentions, because there is no success of the NBU on the way to EU accession. It will be worth nothing. It will bring additional challenges only, but the synergy effect will be achieved when we have the field of joint actions inside the country and together with our European partners. We can discuss separate regulations because we are dealing with these issues daily. But now it seems to me it's very important to feel this proper wave of our cooperation with our colleagues from the European Commission. We want to achieve smart architecture. We believe that there is an inquiry for this both inside the EU Commission and the need in Ukraine. And we are not asking for concessions. We, with all respect, we offer comprehensive partnership because this ideology was in the foundation of the European Union, the union which will be a sum of solutions adopted during crisis, as Jean Monnet said. And let it be, we are not generating challenges, we can offer solutions.
Thank you for that. To Vitas, do you have any suggestions when it comes to what practical actions can EU institutions and other member states undertake when it comes to actually helping out in this process? Because you have seen this from within.
Yeah, so I think that the straightforward answer would be cooperation, you know. So and of course, the increased level of cooperation could give additional speed for this harmonization process. But of course, maybe the most important thing would be the homeworks, and I think Sergey and Andriy they talked a lot about financial sector harmonization, you know, and based on my experience, I can only say, guys, just take this acquis communicare, just implement it, just harmonize your domestic regulations, and then you will see. You become a member of the club, then you will see. You will sit on the table, then you will decide, you know. So just take it.
Thank you for that, Sergey. Given what you have heard so far in this conversation, anything that you would like to add in terms of what's waiting?
Цікаве питання щодо досвіду
Quite an interesting
трансформації.
question in terms of the experience
Знаєте,
of
зараз ми
transformation.
проходимо досить
You know,
такий
now we are approaching
цікавий етап,
quite an
коли
interesting
ми
stage
маємо
when we
максимально
have
чітко зберігати
to
стабільний
preserve
рівень
the stable
довіри
level of
до
trust
інституцій,
to the
до
institution,
нашої
to our
спроможності
capability,
і до нашої
and to
можливості
our
виконувати наші зобов'язання.
possibility to fulfill our
І якщо
obligations.
порівняти
And if comparing with
досвід
the experience
роботи з європейськими
well,
структурами,
with the European
іноді ті
structures,
питання, які виникають,
sometimes
складності,
the
які
questions
виникають на
and
цьому шляху,
complications that arise on this way,
я б сказав би, що
I would
це досить
say
жорсткі
that
іноді
these are
перемовини,
quite
досить
tough
іноді
negotiations sometimes,
складні дискусії.
tough discussions.
Напевно, більш жорсткі дискусії у нас
Maybe
можуть бути
tougher
тільки
discussions
з
we
нашими
only have
партнерами
with
з
our
МВФ.
partners from the ministry.
Але з нашими партнерами з МВФ це досить коротка дистанція. Тут або ти домовився, або не домовився. То з європейськими партнерами ця домовленість розтягується іноді в перспективу,
But sometimes
в
this
якій
is
кожна
a conversation
сторона
for the perspective
намагається
where every
намагається
party
переконати одне
is doing
іншу
its best at
тому,
convincing the other party
знову ж
that
таки, що це можливо або
it
неможливо.
is possible or impossible.
Дякую за
Thank you for
цікаві ідеї, як нам можна було
the
б це
interesting
швидше
ideas
зробити.
on how to accelerate the process for
Краще
us.
зробити,
It's
а
better
потім
to do
думати,
something
яким
and
чином
after that ponder
адаптувати,
how to adapt
ніж
it,
розказувати, чого
than
ми не
to
можемо зробити,
talk in
і
depth
розказувати,
about
чому
what cannot be
у нас
done,
це неможливо і чому ми
why it cannot be
унікальні.
done and why
Ми
we
можемо
are
бути
so
унікальними,
unique.
але не
We
в
can be
Європейському
unique, but
Союзі.
not in the EU.
Якщо ми хочемо
If
бути
we want
країною
to be
Європейського
a
Союзу, ми
country,
маємо
a EU country,
погоджуватись на
we
ті
need to to agree for the rules and the regulations that are already there. Yes, it's complicated, sometimes it's uncomfortable, sometimes it builds barriers and additional challenges. But I believe that my colleagues of neighboring countries who have already done this challenge, their experience demonstrates that it's better to go and do the work than to extend it for a long period of time. The war has given us a wonderful chance, in addition to all the horrors, to understand that we don't have time to procrastinate. Either we adopt these regulations and laws, or we will suffer for a long time. It is better to suffer for a short time, to adapt and to do whatever is necessary. We have a very constructive dialogue with our partners in the framework of the Ukrainian donor platform. We have already held 13 meetings. Very soon we will have the 14th meeting. We actively discuss all the questions that move Ukraine forward. This is the issue of reforms, the issue of financial provision, rebuilding, the recovery. I believe that in this dialogue and in continuous dialogue, we will only become closer to each other and understand the challenges and the tasks that we face and implement them as fast as possible. That's why we are grateful for the opportunities that the EU opens in front of us. We maybe need to communicate better, demonstrating these perspectives for businesses, for the Ukrainian citizens, to give them possibilities to understand why this perspective is useful for them. Because this can be useful for a specific group of citizens working in the government, but if it's not quite clear for the general society, it is bad. We really need to communicate it better. That's why these conclusions that I will make at this panel. Thank you.
Thank you for those very wise comments. And now over to Jacek. And from your perspective, since you are part of the system today, and you have also seen this for some time from within when it comes to financial systems, what, in your opinion, then what can individual jurisdictions then do in anticipation of EU integration? And that's sort of a very kind of general question in terms of doing things in such a way that eventually the whole exercise is successful.
I'd like maybe to answer your question, but also to go back a bit. One of the comments made by Governor Andriy Pyszny before, because of course drawing on our experiences from the before Polish accession. I mean, to some extent, it's not comparable, because what we've seen over the last 20 years across the Union is a significant increase of the volume of the regulations that we have in place. So we can tell from our experience that implementing the entire acquis communautaire was a challenge before 2004. But now I can imagine if we compare the volume of financial regulations in 2004 versus the volume of financial regulations in 2025, it's a different world. If you look at the number of pages, if you look at the number of delegated acts, if you look at the scope of the regulation, which is intended to cover more and more areas, including crypto assets, including operational resilience, and all the others. So, what struck me as a very interesting insight in Governor Pyszny's comments was that now we are having this discussion at a very unique moment in time for the Union itself. Because our understanding, and probably we share this understanding, is that decision makers, policy makers in the Union have come to a conclusion that we've gone too far in our approach to regulating the financial markets. The regulations are overly complex, to some extent overly detailed, to some extent maybe overly rigid as well. And we see also as a demonstration of political will and political commitment at the level of the European Commission, which is clearly evidenced by the omnibus packages, which are aimed at reducing the regulatory burden and at simplifying the regulatory framework in the Union itself. And I think that this can create a very interesting momentum for the discussions with candidate states, because Governor Opishny mentioned that we should be focusing on finding ways how to smartly regulate. We should be coming up with smart regulations. And I personally, I believe that's a very interesting comment in this context, because I think that having these conversations with new member states or with candidate states actually may breed some new air into these conversations that we've been having in the Union for years, because now we will be entering this discussion with someone who wants to follow the general principles, but may have a brave new approach to some of the detailed topic. I think this can be very interesting. So one of my takeaways from our today's discussion will be definitely that we are talking about an accession process in a very interesting moment for the Union itself, especially in the financial market. Because on one hand, of course, new member states will have to adhere to the acquis communautaire, but on the other hand, the acquis communautaire may also be evolving in a direction which is opposite to the direction of its evolution for the last 2 or 3 decades, probably, which will be more aimed at simplification, making some step back, maybe in some of the areas, leaving more space for the market participants, leaving maybe more appetite for risk, especially in the areas of capital markets. So that will be definitely a very interesting dynamics to follow, and also going back to the interplay, to the equilibrium between strong state and strong society, or strong even business. Because talking about society, I also mean about business associations, about market participants. What we are particularly proud of as a microprudential supervisor for Poland is that we are able to, while acting and staying within the narrow corridor, we are able to achieve many of our supervisory goals or regulatory goals without referring to, let's say, hard powers, without referring to enforcement, without referring to administrative actions or administrative sanctions. And I believe that's something that probably also Ukraine, as a candidate state or as an economy that's converging with the economies of Europe, should also try to focus at, because we believe the quality of the economy, the quality of the society can be measured also to some extent by the efficiency with which we can achieve our goals, our macro goals, without referring to use of administrative powers, administrative sanctions, or enforcement proceeding, but by moral suasion, by dialogue, using our, let's say, not formal authority, but our intellectual and moral authority. So that's something I also believe is very important in the context of demonstrating where we are, and that we are in the narrow corridor as described by the professors, that we are able to achieve strategic goals in a dialogue, and without referring to, let's say, to formal authority, but based on our, say, moral authority and on the position that we have established among market participants in Poland. And that's something I think that 2 takeaways from that are interesting, very interesting to me from the previous exchange.
Thank you for those very interesting remarks when it comes to finding a strategy how to get things done. Now, when it comes to getting things done, there are very few minutes between this panel and lunch. So I'm just going to take one question on one side of the audience and then another question on the other side of the aisle, and then we'll break for lunch. So who would like to start? There is a hand up there. Oh, there's a microphone coming there.
Thank you. My name is Olha Zadorozhna. I'm from Kuzmiński University in Poland. So I have a question concerning the Euroscepticism prevalent now in Europe and the lessons that Ukraine can learn from the experience of member states, and also the lessons that other member states can learn from Ukraine. And I will elaborate a bit more. My point is that, the research has shown that Euroscepticism is connected to, well, economic growth, among other things. It seems that this relationship is not linear, because we have a case of Poland, for example, that was not affected that much by the economic crisis and great financial crisis. But on the other hand, we see that Euroscepticism is rising there as well. So economic questions, probably they're not decisive here. And I'm wondering what Ukraine can do to safeguard itself from Euroscepticism after it joins the EU. And another part of this question is, well, in Ukraine, as probably you know, people are very for European integration. More than 85% of Ukrainians, they want Ukraine to join the European Union as soon as possible. And this has been there, this feeling since 2014, Revolution of Dignity. And so the other part of my question is whether there is anything to learn from Ukraine's experience for the European Union countries. Thank you very much.
Thank you, and thank you for that question. And one answer, please be very, very short.
Дякую вам за це питання.
Question. It is crucial. There is a brief answer and there is a longer. The short one. The process of Ukraine's accession to European Union may allow us to remind you of value of this integration. Integration that exists today in the countries that are members of the European Union is already taken for granted, is already a political fact. Christine Lagarde said in her speech, don't take any reforms for granted. Be very careful about how people perceive this context. Sergei mentioned the issue of trust, and this is very important because we see trust as a resource to make appropriate decisions and build appropriate communication. And to build this very important, one of the walls of this narrow corridor. I really love this metaphor. The society should accept it. And when we are talking about the EU accession for Ukraine, it is the moment to say, look, how valuable is what you have, because it costs us hundreds of thousands of lives, maybe the whole generation, part of territories, 1/3 of our economy. It became the trigger for revolution. Everything to be a member of a large, successful, value-based Europe. This is the real price of what you already have. EU accession for Ukraine is just to remind you, it's a very strong antithesis to fragmentation. Euroscepticism is just, to clear dust from integration, as from some just political statement. No, it's a source of survival. It's a resource, your joint resource you own together. And we want to have it as well. That's why we are aiming to be a part of Europe. And new EU accession, considering all challenges and uncertainties, should create strategic autonomy. Mario Draghi's report, is now cited and quoted everywhere in each communication. Take it as a challenge to be overcome. And here, Ukrainian experience, our strive, our vision, and we learned to be very flexible, very adaptable, and very determined on the way to what we are aiming to achieve. It can be a good moment for you, can trigger maybe some internal discussion about where Euroscepticism can bring you. We want to be a part of Europe, but this movement should be both ways. We don't want, to chase the target, the moving target that can change its direction, that can change its speed, or just move into opposite direction. No. Let's see the EU accession of the country like Ukraine as some ground, some trigger for deregulation, for competition, for expansion of single market. There are many topics we discussed, and Christine Lagarde disclosed a lot. Indeed, we did not align our speeches, but these topics, are on the surface, are on the table, and I believe that contribution of Ukraine to this process, to, enhance what you have already today, to feel its value, is very important. Our interest in this issue is obvious. We want, as soon as possible and as efficiently as possible, to join the European community, and we will do our utmost. We will try to comply with your requirements, but we want these requirements to be discussed, because maybe you are not happy with them yourselves. Let's have a look. Maybe something can be changed. Let's not chase the moving target together. Let's be very aware and in each of our decisions. And this awareness is needed both by you and us, and we can be a source of strength for the European Union.
Thank you. Thank you for that. One more question, if there is one from that side, extremely short, because the clock is actually more intensively flashing red on my screen here. I see no hands up. Then it's time to break for lunch, and thanks a lot to the panelists.
I'm joining to this round of the applauses, and let me thank you for this insightful and really thought-provoking conversation. Dear guests and participants, a little announcement before we start our lunch, please. We will have the second part of the conference after the break, and then we have evening gala reception dedicated to the poets of the executed Renaissance. I'm sorry, it's a little bit difficult in English to say this word. Renaissance era. So I really hope that you will stay with us, and we will spend this evening together. Now we have a lunch just outside the hall, and we try to start promptly at 2:15 p.m. I understand that it will be really tough to do, but please try to be in time at the hall, and we will continue, we will turn to our program. just 30 seconds or a minute, not more, because our guests are here, our esteemed panelists, and we really want to move forward with them. So I think we are ready, and we can start our second panel. The topic is balancing single market principles with industrial policies and economic security system. The second panel will focus on a key dilemma: how can governments support strategic industries and ensure economic security while upholding the principles of the free single market? Speakers will discuss Ukraine's policy course as it aligns with EU standards amid war and facing the pressure of the recovery. This panel is moderated by Olena Bilan, Head of Research, Chief Economist of Dragon Capital. I invite Olena to start the panel by introducing our esteemed panelists, so have a nice conversation.
Thank you very much. Good afternoon, everyone. I would like to invite all the panelists to take their seats, and we will start right away. And I will introduce you while you will be already here. Please. Okay, everyone is here, great. Yeah, it's definitely a great pleasure to be here and to have the, such a professional and distinguished panelist. So welcome to our panel discussion. The topic is quite difficult, I would say. So the topic is how to balance the single market principles with industrial policies and economic security. But I hope that with the help of our panelists, we will go through it. So let me introduce all the panelists. So next to me is Jeroen Klik. Jeroen is an IMF Executive Director for 16 countries, right? Including Ukraine. So Ukraine and 15 countries. But also Jeroen served as macroeconomic advisor to the Prime Minister of Belgium. And what is relevant to Ukraine, in this position, he led Belgian policy response on the windfall profits from frozen Russia's assets. Next to Jeroen is Madame Ambassador Katarina Maternova. Prior to her appointment in September 2023, Madame Ambassador was a Deputy Director General of the Directorate General for Neighborhood and Enlargement Negotiations of the European Commission. So it's a very long name. I think the short name is DGNIR, right, which is basically a body responsible for the EU enlargement process and neighborhood policy. And for 3 years, she simultaneously acted as a head of the European Commission Support Group for Ukraine. Ambassador Maternova held senior management and advisory posts not only in the European Commission, but also in the World Bank and in the government of Slovakia. So next to Madame Ambassador is Mrs. Olga Stefanishina. I think no need to present her, but I will do, because actually Olga served in the government for Ukraine for 18 years, if I'm not mistaken, and spent all her, sorry.
No, I just said that we look like sisters with Christy.
You don't need to change seats.
Which is a huge compliment for me.
Thank you. Sorry for this. But let me finish. So, Olga spent most of her professional career, actually devoted most of her professional career to Ukraine's European and Euro-Atlantic integration. Now she is a Deputy Prime Minister for European and Euro-Atlantic integration, and also the Minister of Justice, and she chairs Ukraine's delegation on EU accession negotiations. So, and not to mix, Kristina Mikulova, head of the Eastern Europe Regional Hub of the European Investment Bank. So Kristina, I think, was appointed to this position last year. And before that, she was EIB's representative to Lebanon, which is another difficult country. And before that, she was a senior policy advisor in the bank's operations department. And Kristina worked also in the World Bank, and she had some experience with the Mashrek region at the time of the Syrian refugee crisis. And we have here Natalia Shapoval. Natalia is Vice President of the Policy Research at the Kyiv School of Economics, and she also leads the KEC Institute, so one of the leading Ukraine's think tanks. Natalia is a member of the Yermak-Makfol International Expert Group on Russia sanctions, and she also a member of the Economic Policy Advisory Council to the Ministry of Economy of Ukraine. So with this introduction, let me first of all say a couple of words about the topic of our panel and well, why we generally discuss these issues. The reason is that the European single market has been at the heart of the Ukraine's, of the European project, not yet Ukraine's, but European project. It has been one of the EU's greatest achievements, and it promoted efficiency, competition, and growth. But as global risks intensified, so European countries started or turned to sectoral policy interventions to increase economic security and enhance productivity and accelerate green transition. I came across an IMF study, recent study that states that government aid spending by European Union countries increased 3 times over the last decade to 1.5% of GDP. And this was in 2022, so after the COVID years. And during COVID years, it was even higher. At the same time, we are meeting at a time when economic security has reemerged as a central concern. So definitely because of the Russia's full-scale war against Ukraine, but also security risks in other regions. And typical strategic considerations at the face of this kind of security threats is to develop production of strategic goods at home, not to let even your probably partner to develop this production. And definitely, country needs to spend more on defense, but their fiscal space is limited. That means that they need somehow to rebalance their fiscal spending, to cut something, including the state aid, including maybe their industrial policies. So we will try to here to find an optimal strategy, or at least a balance between these 3 things. So openness, and basically the European single market principles, the industrial policy, and security, including the economic security considerations. And I welcome each panelist to provide a short remarks on how to balance these 3 things. I will start with Mr. Klik, please, from the IMF.
Okay, thank you very much. It's a privilege to be here in Kiev. And before I start, I wanted to make an observation, because it's fantastic to join this panel, and normally I'm surrounded by men, and this time I'm surrounded by women, so it's fantastic. So I think that by itself deserves already an applause. So I'm very proud to be in Kiev today, and also proud that Ukraine is a key member of the constituency that I can represent and the executive board of the IMF. Of course, there is always the usual disclaimer that the views that I present are my personal views and they do not necessarily reflect the views of the entire board of the IMF. Before we begin, and also Mrs. Lagarde has pointed out this morning, something like this, that central bankers often talk in a special code. Well, we have at the board of the IMF also this tendency to speak in code. But now I don't want to speak code, and I want to speak straight from my heart, because I want to express my deep sympathy and strong support for the people of Ukraine. In the face of Russia's brutal and unjust war, your courage continues to inspire the world. You're not only defending your country, you're standing up for the values that we all share in Europe. That's freedom, democracy, and the rule of law. I also want to commend the governor of the National Bank of Ukraine for convening this important discussion in times of war. It's a powerful signal of leadership and a clear commitment to Ukraine's future in Europe, not as a neighbor, not as a candidate, but as a full member which will make Europe stronger. So now let me go to the heart of our discussion, and let me start with some key dynamics that are shaping the current landscape. We at the IMF, we see the global economy in transition. Fragmentation is accelerating, strategic sectors are under pressure, supply chains are being reshaped, and the rules of global trade are being rewritten. And in this shifting landscape, this session is very timely, because it discusses the interaction between industrial policy and the cornerstones of Europe's economic strength, and that's the single market. The single market, which was built on scale, openness, and trust, remains Europe's greatest asset. And the point I want to make today is that in today's context, industrial policy is about macroeconomic policy making. It is shaping investment, productivity, fiscal space, and debt dynamics. And in Europe, it has cross-border effects, positive when coordinated and destabilizing when fragmented. And at the IMF, and we have referred to that in the beginning, we have done some research on industrial policy. And we see both the potential, but also the pitfalls of industrial policy. Industrial policy can accelerate the green transition, secure critical inputs, and build strategic autonomy. But without clear goals and strong governance, it can also distort markets and supply chains, misallocate resources, undermine fiscal discipline, create uncertainty, and delay investments. And if left unchecked, it can even trigger subsidy wars and deepen geo-economic fragmentation. And that is why the IMF is advising its membership to design smarter industrial policy frameworks. And these frameworks, they should be targeted, transparent, and grounded in strong institutions. So, what does a strategic industrial policy look like for the IMF? Well, first of all, it starts with purpose. The support must go to where it creates long-term value, like green infrastructure, frontier innovation, and technologies enabling strategic independence. It must also be disciplined. That means time-bound, performance-based, and open to all firms, not just to national champions. It must also be fiscally sound. Public support must fit within sustainable budget, Strategic does not mean unlimited. And it must be governed well. Without strong oversight, even the best intentioned support can distort markets, lock in inefficiency, and erode public trust. So, but let's also be clear that industrial policy, it's not going to be the silver bullet for all the macroeconomic challenges we face in Europe. We still face deep structural challenges like low productivity growth, limited labor mobility, an incomplete single market, and underinvestment in innovation and infrastructure. And also for those issues, they need to be addressed, and we require a clear vision and leadership. I also want to say a few words on defense, because here in Kiev, its importance is not theoretical. It is real. For Ukraine, and actually for all of us who believe in freedom, and in this world we are facing, defense is no longer an abstract policy. It is a daily necessity. And in my opinion, we need in Europe a defense industrial strategy, one that matches Europe's ambitions. What does it mean? It means joint planning, pooled demand, and long-term investments. It means fewer barriers, more trust, and a shared sense of purpose. Because defense manufacturing is just like semiconductors or green tech. It requires scale, certainty, and long-term planning. It cannot be rebuilt through 27 uncoordinated national strategies. So we must build a European defense industrial ecosystem that reinforces the Union's strategic autonomy. And this, of course, without undermining NATO or fiscal responsibility. And in doing so, I strongly believe that Europe can learn a lot from Ukraine, from the strengths of its army and the resilience of its defense industry. And I think this is a message that needs to be echoed much more, because the EU enlargement, it's not only in Ukraine a territory full of challenges, as the governor told us, but also in the existing EU countries. We need to clearly communicate on the benefits of enlargement. Having said this, I also believe that the IMF should invest in building a dedicated research capacity to better understand the macroeconomic implications of rising defense expenditures across the world. The IMF has always been quite neutral on defense expenditure, but we come at a point now that we need to better understand the impact of these growing expenditures on potential growth, inflation dynamics, and public debt sustainability. Let me close with this, and that is that I strongly believe that industrial policy is not a threat to the single market, because if we get it right, we can leverage the single market as a platform for strategic action and a tool for resilience, innovation, and transformation. I will stop here.
Thank you very much. That was a great start, and you described a very nice framework. And I would like to ask Mrs. Stefanishina basically to comment on the same question, but also give us a little bit of overview of Ukraine's industrial policy and give your opinion how is it aligned with these principles that Jeroen just described, so that it should be targeted, transparent, fiscally sound, etc. Please go ahead.
Thank you so much. I was just making some notes right away, and I think it's very interesting for international guests to see how do we see single market from the perspective of Ukraine, and this perspective is very different. It is very different from the perspective of country cooperating with the European Union and from the country joining the European Union. So these are two different approaches, and these statuses have significantly affected the policies and priorities for Ukraine. And I also see that the answer to the question, which is the title of our panel is how to balance, is not something that we just discussing today, is something which has been already announced by European Commission as the major deregulation effort the Commission will undertake to make sure that the principles, the freedoms of the single market, they are reviving, and the Commission starts the new era of regulation, which would serve as an enabler of the single market, enabler of these freedoms, because the initial logic was not to make sure that there are no barriers between the members of the European Union, and no trade barriers, no economic or fiscal barriers. And then the single market made a decision to become a champion of a green transition. Then there was a lot of things related to standards and equality, but also there has been an era of single market where the single market has been posing a lot of barriers to trade to secure itself. So here we are in 2025, where a single market has transformed from the idea and survived different political periods. So it's a perfectly natural decision to reflect on these periods and start winding back something that burdened the market and deterred the European Union from being even more competitive and more strong player on a global arena. But this is now I'm speaking also from the perspective of a person who has been dealing a lot with the European law, with European acquis, but also as a chief negotiator for my country's accession to European Union. But there was a different time. All right, the different time was when Ukraine and European Union has signed the free trade area, the association agreement. And now we thought that it's such a perfectly natural decision, and of course it was the decision after the revolution of dignity. There was like a lot of politics in that, but more than 10 years after, we see that there are not too many free trade areas European Union had the arrangement on. There were like a lot of plans and ideas, but it's only Ukraine and Canada. And I don't think that there are like so many perspectives in having the deal on the Mercosur agreement, which affects now a lot of discussions. And then we thought that this balance could be reached in Ukraine by prioritizing sectors, so that Ukraine could become a part of European single market in specific areas, not putting the whole ambition there. So we prioritized something that was possible through the association agreement, and Katarina remembers it very well. We started to call it sectoral integration. So, and this is a processes which have been lasted for years, because we had to ensure the regulatory framework and institutional framework aligned, and it was vital when finally we reached the point of 2022 when the full-scale invasion started, and Ukraine has become part of energy market. Ukraine has signed the transport liberalization agreement. Trade liberalization arrangement was made by European Union on a unilateral basis. We also have yesterday joined the roaming area, and we are on the way in all the sectors, and it's very important. This is also the option which has been later explored by many other countries of the region. So it's also a very I think interesting perspective for European Union to look from within, that instead of being too protectionist, you can choose and prioritize the areas where you have no problems in admitting the players from the third countries to your market, rather than, blocking everything. And, we are also a country having this experience, right? Finally, I think the discussion on defense industry, what you raised, I remember it very well. In the beginning of war, we had a lot of contacts and engagement with the European Commission, enabling all the decisions I mentioned, but also there was a desire to do more in terms of military support, in terms of defense support of Ukraine. And there was a discussion, how can we use the potential of the single market to make it possible? It was not possible just to procure the weapons through a single mechanism. There was a discussion like that. But then we understood that defense industry is the market. And this is where you cannot find a better player than European Union and European Commission. And it evolved in a lot of initiatives like the Rearm Europe and etc. And to the calculations we heard from the Commission that it would take up to 5 years to reach the potential where this market could be fully established and competitive with the bigger players you all know. So I think we are on a way to a better shape, to a stronger European Union and a single market. We still have to overcome some mental barriers, like from one side deciding that admitting Ukraine to European Union is the very important geopolitical decision-making European Union stronger in a strategic perspective, and being afraid of this decision on a tactical perspective. So I think we will pass this over. But if the policy of European Commission on deregulation and putting more enablers to the freedoms within the single market would be successful, I think we will be in a better shape. And I see here Sergei Nikolachuk, he's our negotiator for the freedom of movement of capital. He did an excellent job, but the interesting experience that while we are negotiating the accession and while we are negotiating some future obligations, we have a reservation from the European Commission that by the moment you will start adopting it, they might be cancelled, or how is that in English correctly? So they might be just cancelled as a regulation. So we're in a very different and dynamic framework, but I think the strategic view is correct, and I think I can really have enough leverage to state that so far European Union has been the most flexible organization, or whatever, union of the states, and the level of adjustments and which have been possible through European Union since the beginning of the full-scale invasion is unbelievable. I haven't seen it anywhere else. So there are a lot of potential. I would not be depressed. So by some negative instabilities globally, I have this confidence that EU will survive because it has been able to adjust to any reality, including the reality of a full-scale invasion.
Thank you, Vice Prime Minister. Madam Ambassador, do you share this view that the EU is very flexible and maybe a little bit of provocative questions that I would like to cover when you will be answering our main question. Mrs. Stefanishina said the single market has survived, but if you look at the map of the temporary borders or within the EU, I think it's almost fully covered. So basically, one of the key freedoms is the freedom of movement of people might be at risk. Please, would you please comment on this too? Thank you.
I very much agree that we have proven a lot more flexible and a lot more forthcoming, and we managed to cross many Rubicons since the full-scale invasion that were difficult to imagine before. I never thought I would be in the business of neither building shelters in schools nor in the business of supplying resources to the Ukrainian defense industry or purchasing weapons, and it happened. So I think that while not perfect, we are slow, boring, difficult to decide, but actually once the tanker moves, it's a dependable machine. And I'll come back to the four freedoms. But let me make 3 points, and let me start by declaring my bias. Whenever I hear the term industrial policy, I get extremely suspicious immediately. And I very much like Jeroen's outlining the need for transparent, temporary, well-governed, based in institutions, and fiscally sound of transparent rules governing industrial policy. But perhaps because I spent a number of years in charge of the regional and urban policy in the European Union, I tend to see the pitfalls and the very easy sliding into picking national champions or picking champions who are friends, and in fact the over-subsidization that is very much hallmark of Europe, and as you cited at the beginning of the figures about government aid, that's the flip side, and that's why I'm very careful about it. So that's my first point. The bias when I hear the term industrial policy, which leads me to the issue of the single market. You mentioned it's the greatest achievement of the EU. Yes and no. It is the greatest achievement. The four freedoms of movement, capital, goods and services is certainly something that is worthwhile working on, but let's be quite honest, we are not there yet. We are quite far from being there. And I'm now not even talking about the immigration anxiety in Europe impacting the freedom of movement, or even the temporary block on freedom of movement when new entrants came into the EU. I'm talking about things that are not even tackled. If you are a hairdresser in France or a hairdresser in Lithuania, you cannot go to France and open a hairdresser shop. I mean, it's at that level of intervention where even the simplest type of services that should not have high barriers to entry do have them. And then it impacts the whole economic engine. You mentioned the low productivity, rigidity of the labor market, very big difficulties in accessing capital, both at the small level, you know, the loans, as well as raising large amounts of resources. These are still problems in the single market, and I assume, I only came at the end of her speech, I assume Christine Lagarde would have mentioned her predecessor's report, Mario Draghi's report. He spoke about 3 big issues that Europe faces. One is the innovation gap. Second is the tension between decarbonization goals and competitiveness. And 3, problems with Europe having lived under a security umbrella of the US for decades and not having sufficient security and over-reliance on other parties. And we see that playing out here. So we know the ills, and I'm not going to solve the ills here, but I'm going to offer as my 3rd point, perhaps counterintuitively, to say that all of these ills would be much easier to solve in Europe with Ukraine as a member of the club than without. Let's start with the security. You know, in today's dangerous world, I want Ukrainian army having my back, not facing me. And I think that's very much something that many feel these days. Second, on the decarbonization and competitiveness, the natural resources, in a post-war scenario, the energy abundance, the green energy abundance, the minerals, the human resources, the resilience of the people, and the agricultural land are all things that would very much help on the competitiveness as well as the decarbonization goals of the EU. And let me finish on the one that is now, fortunately to those who know, becoming indisputable. It's just not everybody knows that. The innovation capacity of this country that you can see through the DIA application, that is the most digitalized country in Europe, and the defense industry innovation. The innovation cycle in this country is not years, not months, is days and weeks. And that would certainly, with Ukraine, we could cover the innovation gap much easier. So that's my comment on industrial policy.
Thank you very much. I would like to pass the floor to Natalia Shapoval, because Natalia has a meeting, important meeting, and she has to leave earlier. So Natalia, please comment on the key theme of our panel, but also because I will not be able to ask this question later, I would like you to comment a little bit of sanctions, because you're really an expert in this field. And my questions on sanctions would be very simple, actually. Did they reach the ultimate goal? Basically, the ultimate goal of any sanctions is to change the behavior of the sanctioned country or individuals. And do you think it's, if not, do you think it's realistic to expect that it will happen? Please go ahead.
Thank you, Elena. So I'll start from the end and connect to the broader theme of the discussion that, the ultimate goal of the sanctions is to reduce revenues flows for Russia to finance the war and reduce their access to technologies in the West that they used for weapon production. And fundamentally, there is a lot of achievement. First, Russia cannot borrow, central bank reserves are frozen. This year, they're going to have the budget deficit that is larger than their national wealth fund reserves. They already need to borrow on the internal bank market, basically from the state-owned banks, really significant amounts, bigger than their banking liquidity estimates. So a lot. And that being said, the effect is there. We estimate that because of the discounts on the oil, they received 115 billion less of revenues, export revenues, since the beginning of the full-scale invasion. So it's significant. They lost the European market of gas. Gazprom reports significant losses. They hide it. They have debts. They have basically all energy sector except for Rosneft and Lukoil. They are two majors. Everyone else reports significant losses, so they are stretched. That being said, If we compare Ukraine and Russia, and even Europe and Russia, for Ukraine we have the struggle to finance 40 billion of external financing gap, and for Russia 40 billion they can accumulate of this deficit just in a half a year, and it's like not a big deal. So if you look from the angle of this security and sanctions, it's like Europe and Ukraine and US, everyone struggles to do this 40 billion for Ukraine and for Europe for defense, and for Russia it's like peanuts. And it's really frustrating that this balance of how Ukraine and the West is capable to mobilize funding is still weaker than how Russia is doing that. At the same time, I see a lot of potential starting from this year happening exactly in collaboration inside of the European Union and between Europe and Ukraine in all these programs like SAFE and in additional borrowing on defense, and all the stimulus and incentives to collaborate inside of the Europe on joint production, on production with Ukraine for weapon. And I think this is a very positive way forward and another angle of industrial strategy in a sense, because this is like what's going to be growing. It's growing in Ukraine. This is where you can get return on investment if Ukraine, like if we assume that regulatory framework will allow for it. But also in Europe, given the strategy, which I think is very well thought, there's going to be return on investment on these markets in the weapon production, dual use, and all the positive spillovers. So I hope there is this joint path where joint production and maybe borrowing and financing gonna kind of be closing this gap in Ukraine that we need to continue the war, to continue the defense, and at the same time fueling also innovation and production in both here and in Europe.
Thank you. So to put it short, your answer to this kind of a very difficult question is to have a joint production of defense goods, right?
Yeah, I feel like some Republican in US, like just produce more old good weapons, but a little bit, yeah.
Okay, thank you, Natalia. Christina, let's go a little bit back to the main topic of the panel, and I would like you to also discuss this angle of limited public funds and how can we really, balance all these things with the public finance being very stretched in Ukraine and definitely not in a excellent position in Europe. Thank you.
Thank you very much, Olena, first of all, for such a captivating topic, and then for the impressive lineup of panelists. Extremely happy to be here. And I see that each and every one of us has adapted the answer to a certain extent to the DNA of their job, of the institution they represent, of the work that they're actually doing. So I'm going to do the same. And I'll start with what balancing means for us. The European Investment Bank, Bank of the European Union, everything that we do here is supported by EU guarantees, very often blended with EU grants, and also tries to forward and foster the European integration process, right? But let me look back to why the EIB was actually created in the post-war period, right? It was no Marshall Plan, don't get me wrong, but at the same time, it was created to foster, to a certain extent, a cohesive and balanced development of Europe at the time, right? And this is very much in our DNA and how we see our work here. So the way I would like to start is explaining to you how this balancing looks on the ground. Because as you have already pointed out in your introduction, I have started my position about 8 months ago. And one of the missions that I've set out for myself is to visit every region of Ukraine by the time I reach the first anniversary. So let's see, maybe this is too ambitious, but I've already visited quite a few places. And what I see playing out is a certain amount of tension between the EU frontier, so the regions that are already engines of the economy closest to the European Union, where we are compelled as part of the European integration process to keep strengthening meaningful connections, right? And at the same time, the front line. So the frontier and the front line. And the front line, the most affected, suffering on a daily basis, right? I was just in Zaporizhia last Friday, together with Katarina and a few other colleagues. where we will have an immense amount of work to do, not only after the hostilities cease, but it is also work that we're already doing now, right? This is what has impressed me most about Ukraine. Nobody is waiting for the end of the war, whatever that should look like, to begin the reconstruction. It is already ongoing. What we're lacking, of course, is scale, right? Which is here, and also what you mentioned, as a really strategic part of the work that lies ahead. So balancing this, right? Work on the frontier with the work on the front line, both are acutely needed, and this is what we are seeing as the EU Bank engaged here on the ground. Let me now transition to the path that lies ahead, right? European integration is a process that is anchoring reform, that will be anchoring reconstruction. Here, Olga and Katarina are the experts. What I may add, since, like I already mentioned, we are also a vehicle of European integration and EU policies, is the fact that, contrary to what some people think about us, most of our work is actually in the European Union. We have gathered a lot of experience with working with candidate countries, with new members, and so on. One of our greatest mandates is cohesion. This is what I mentioned at the very beginning as an essential part of our DNA. And we can also point to the twists and turns that member states that have joined, I would say still recently. You may argue that 20 years ago, for example, my country, Slovakia, is not recently anymore, then we have Croatia, but still, this path entails certain pitfalls, and lessons have been collected that we have seen by working with these member states that can be easily avoided, right? We see that the EU accession process here in Ukraine is already a powerful driver of structural reforms, and we have noted progress that is actually impressive in wartime circumstances, in the movement of goods and company law, digitalization that, as Katarina also mentioned, as really advancing so quickly. Challenges remain, for example, in state aid control, competition policy, and so on, right? The lessons learned that we have gathered through our work with countries like Slovakia, Hungary, Poland, Romania, Croatia, entail several instructive things. First of all, industrial policy should support integration with EU value chains, but focusing also on upgrading the technological content, right? And moving beyond basic raw material exports. This is an obvious one. We also need transparent frameworks for state aid and subsidies, transparency really being the operative word, because I don't think we can completely avoid them. Looping back to what I said at the very beginning, the massive differences that we are now observing between different parts of your vast country. But they need to be transparently distributed based on well-defined methodologies. And this is to maintain trust, not only with EU partners, but also to maintain trust here in the country, within the central government, between the central government, regional, local authorities, and so on. And let me point to a few of these lessons learned from Central Europe and Southeastern Europe that we have seen playing out. And notably these two traps, right? The first trap that you can get caught in when it comes to industrial policy, the cheap labor and commodities trap, right? That Jeroen is well known to all of us, and the low cost and heavy industry trap as well. So let me give a few concrete examples. For example, in Slovakia and Hungary, there was a lot of success in attracting initially FDI linked to manufacturing. However, weak links between academia and industry have not actually enabled them to move up the higher value-added chain, right? So this is one illustration. If you look at that region, also investment in R&D still removes well below 1%. So this points to the lack of innovative potential that we have not managed to actually create through the industrial policies that we have designed. But let's not dwell on this region because we are in Ukraine, and in a way, by looking at these traps, avoiding these traps on the path, you can actually easily leapfrog and take a different path as you're already taking than some of these member states that we have already worked with as the European Investment Bank. And if you put what I've just said into the Ukrainian context, we like to think about the economy as something, of course, dynamically evolving, but the pace at which it is evolving here is unheard of, right? So we have coined this new term that we've been using in our discussion that is called economy of the future, right? It's not only looking at what Ukraine has, what are the comparative advantages, but thinking where the future engines of the growth will be, right? So obviously you have a massive advantage when it comes to the agricultural commodities. You're one of the largest producers of grain, sunflower oil, and so on. However, through the industrial policies that you can design and put in practice, it's important, for example, to support agri-processing, food industry clusters, to move towards those higher value-added products, right? And at the same time, ensure compliance with EU standards. You have industry, and you had an industrial structure from pre-war times with strengths, for example, in metallurgy, steel and iron machinery and equipment, also chemicals and fertilizers, right? However, a lot of this is, for example, energy intensive, and technologically it definitely needs to be upgraded, right? One of the ways in which the EIB is engaging here as the EU Climate Bank is supporting decarbonization strategies in different sectors or state-owned companies, right? Critical raw materials have also been in the headlines a lot recently, right? Here, you do not only have critical raw materials, but also massive energy resources, which means that there are opportunities that lie in the EU Green Deal policies and resilience needs to make these valuable, right? So here, the industrial policy could aim to focus on sustainable extraction, sustainable processing, value addition within Ukraine, and environmental standards, right? So I'll end with something that interests me personally very, very much, because I think we share this with Katarina. I really love the railways. So for me, the railway workers are one of the most important heroes of this war, not taking away from anyone who's fighting on the front line or contributing in other ways to the country's resilience. But logistics and transport, also massive opportunities here, because Ukraine is located at the crossroads of the EU, of the Black Sea region, of Central Asia, right? But realizing its potential as a transport and logistics hub also requires massive infrastructure modernization. This is rail, this is ports, this is roads, and so on. So here I would like to mention that with Lviv, for example, we're developing a transport node strategy that will easily require 10 billion in investment, right? But this allows me to return to the beginning of my contribution, where I spoke about the frontier and the front line, and the need to assure a cohesive reconstruction anchored in the EU accession process, right? And this is what Jeroen has also mentioned in his presentation. For this, you need that intangible cachet. You need trust. And trust is the currency that is needed in both European integration and equitable reconstruction. Trust not only between European international partners and Ukrainians, but also within Ukraine, to build institutional frameworks that work well and processes and standards that facilitate the work that we're doing. Thank you.
Thank you. Thank you very much for such a detailed feedback. Let's move to the second part of our discussion, and I would like to make it a little bit more practical and address a couple of issues that are kind of very close to Ukraine's today's life. And given that I have an opportunity to ask both Mrs. Stefanishina and Madam Ambassador about the Ukraine's EU accession process, I would like to ask you both, where do you see Ukraine's biggest challenges on the way to the EU?
I would divide it into sort of two strands of challenges. One challenge is perseverance on the Ukrainian side through the time of war, and keeping the reform momentum. Ukraine has done extraordinarily well. It has, in fact, written a guidebook on how to reform during a full wartime, and how to do reforms when you are actually fighting for your national survival. But the war's been going on for way too long, and to sort of continue on with the reform momentum is not easy. It's politically not easy, it's physically not easy, it's intellectually not easy. But it's necessary, because the reason why there is goodwill and support for Ukraine is because it's democracy, that we see as a future member state. So I think that's not easy to stay on that path, and that's one challenge. The other challenge, of course, is pro domo. The other challenge is keeping the unity of the European Union to proceed on the path on our side. And I mean, I'm not revealing state secrets to say that there is not an easy consensus on how to move on the path, and I'm sure Olga will comment on that as well. That's something we thought we would be celebrating already a few months ago, opening chapters and clusters still hasn't happened. So the navigating Europe that is going through such fundamental rethink and transformation as it is going through now, with everything that's happening in its security assumptions, alliance assumptions, trading partner assumptions, is not easy. So I think those are the two biggest challenges, because in terms of the preparedness, ability to step in and have the discussions, there is robustness in the system, in the team that Olga has been able to assemble. We provide support. There is a lot of goodwill, but fundamentally we are not only in the area of enlargement, in many others, but bumping against the how to make Europe more adaptable to the new realities, and that's unfortunately also the case with the enlargement policy.
Thank you, Mrs. Stefanishina.
I think we could spend another day here answering this question, but I made an interview to Politico just yesterday, and while talking to a journalist, I said something that I think could really frame this, is that we have done everything which we had to do to enable member states to open the 3 clusters, half of the accession process for Ukraine, including the fundamental one. So it was not an easy process for Ukraine to mobilize the unity over a topic which was the major demand of Ukrainians over the revolution of dignity, the justice, the rule of law, especially on a backdrop of some successes and failures over the last decade. So it was a huge challenge itself for us to prepare this roadmap and the vision, and to submit it for the consideration of the member states. Every stakeholder were a little bit unhappy with what they saw in the roadmap, which is good, I think. So we have taken on board everything, but still not everything for 100%. But so why am I saying this? I'm saying this that making a positive decision, opening the accession talks, it is a technical decision right now. So it's a technical decision. You just need to do it because it's the procedure. If it's merit-based, we have done our job. We have been transparent and open. We are open for assessment, and we are ready to step into the accession process, and we are undertaking the obligations. So it's a technical decision. But not opening the clusters is the political decision, right? So and here's the difference. Here's the deal, like the other president of the United States were saying, right? So and I think this is the whole point of the discussion, that we don't think that this process shall remain technical. We are far from any significant decision when it comes to the real accession of Ukraine. it's just opening the talks. It's opening the pathway for Ukraine to start implementing its obligations. It's far from any decisions related to greater access to EU market or whatever, because trade liberalization is the other discussions, transport liberalization is the other discussions, energy market is the other discussion. It's not about the accession. The accession is about us committing, it's about 27 member states allowing us to reform ourselves in line with the EU regulations. So this is the reality, and this is a technical decision, but not making this decision is a political decision. It's a decision that enlargement is stuck, or Ukraine is suddenly not needed. You know, we do not fit the enlargement policy. You know, and because somebody doesn't like us. So this is a political step. And this is where we are, basically. And we will see whether the decision will be technical or political. I would put it this way. I think it's really hard for us to influence the situation right now. President Zelensky is very proactive in, you know, reaching out the leaders and discussing. We're doing the same on our level, but I think it's now the momentum when the EU has to decide, and I think it will be complicated. But we have the European Council meeting on 26th, 27th of June, and then we will see where we are on the technical side or on the political side. I will put it this way.
Thank you. I think we all hope that we are on a technical side, so it's going to be a technical decision. But my follow-up question, once this decision is made, do you think we have some, there are some areas that Ukraine would need to work very hard on?
Yes, I do, and I already even know. So there, but there's, I mean, there's I need another 5 hours for a discussion. So the very hard, the most complicated area was the movement of capital, because nobody except the National Bank understands what's about. It's like, you know, you read some formulas and you don't understand really whether it's good or bad. So, so we're happy to have the group with Sergey and with the banks and with the association. So it really helps where the institution prioritizes the European integration. Then things become really easier. Because if you're trying to avoid this reality, that becomes complicated. But I think the most complicated areas will be the areas when we have to accept that there are no Ukrainians and foreigners, that between Ukrainians and foreigners, there are 500 million of EUers, right? And they should become Ukrainians in a sense of legislation. This is something which is totally going into denial with everything we discuss. So it's the freedom of establishment, right? It's movement of workers, right? So so this is such a mental transformation, because when you prepare the delegation for the accession, they say, we go to you, we get in there, and then we say, we need to accept the EU in Ukraine. And that really would require a significant amendment of every piece of Ukrainian legislation when it comes to the establishment, to doing business in Ukraine. We really have to become open. That will be complicated. But I think there will be a very complicated area when it comes to climate change and environment protection. So far, this is the longest negotiations process we have within screening. The delegation is working for 5 days, morning to evening, on these areas. And this goes with the single market. You cannot pass away with that. And this is extremely expensive. This is extremely burdening, and this should be balanced with the recovery and reconstruction efforts. That would be really, really complicated. I would put it as on the top level because it requires also a mental transformation, and it requires strengthening the proactive function of state, and it would be extremely complicated for every politician or political leadership which will be coming after us. I hope it will be happening in a normal Ukrainian process, right? So just because you cannot really go populistic. If you want to join the European Union, you have to do a complicated thing like introduce the emission trading system, working on energy efficiency, some nicer thing, right? But there are some not very nice decisions coming into that. So it will be complicated, and it's also almost a 100% case of being hated by the industry. I mean, the one who's doing it is hated by the industry. It's like inevitable.
Thank you very much for your frank answer. Christina, you really interact with Ukraine's businesses on a daily basis because the EIB supports Ukraine's private sector and including the SME. What is your impression? Does Ukraine business ready for all these challenges that Ms. Stefanishina just described?
Well, I can only speak to the work that we're actually doing here, right? And many of us will know us more as an infrastructure bank. And this is absolutely true. Here in Ukraine, 80% of what we do, it's slightly less than before the full-scale invasion, when it was about 70% of what we do. Now, 80% of what we do, and this is the mandate from the European Commission and from EU member states as shareholders, is infrastructure. And 20% is work with the private sector. And here, we're actually focusing on small and medium-sized enterprises that in many economies are really the backbone, right? So I can tell you what we're hearing from them, but let me loop back a little bit to say how what we do in the public and private sphere interact, right? And we've spoken a little bit about the complexity of the journey of European integration. We have also looked at some of the pitfalls on the path that Ukraine's predecessors have gone through, right? So countries of the Central European region, Southeast Europe region. And I'll give you a telling example. So in one of these countries, and I really don't want to point fingers, they established an industrial cluster, right? But there were no investments in connectivity. So you can imagine this industrial cluster, maybe in one of the less developed regions, with companies not really being encouraged, by roads, by other types of services being available to move there, right? So in a way, the regime that you established to support economic activity, productivity, investment was of no use to anyone. So this, to me, is the intersection between the public and the private. And you may ask, well, how did this come about? And this was actually what I talked about before. Trust, lack of coordination between different institutions in the government, a non-transparently designed subsidy framework that didn't really permit this cluster to take off, right? So that said, what do businesses that we interact with see as the main bottlenecks? They say that access to finance obviously remains a major barrier. This is why we work with SMEs, because we often see that they are at a major disadvantage compared to mid-caps, compared to large caps, even though the large caps, if there are any in this room, may have something to say about that. And SMEs tell us that there was a lack of affordable finance even before the war. And obviously the current conditions have even worsened the situation for them because there's an elevated risk premium, there's damaged collateral that they cannot pledge, and so on. So then export-oriented firms, especially in agri-food, for example, and machinery, they then require expanded credit guarantees and export insurance that very often they don't have access to. They also speak to an underdeveloped financial infrastructure which limits investment. So for example, instruments such as securitization, loan syndication, structured finance, they're currently not available, right? I also spoke already about risk-sharing mechanisms that firms are asking for, which are also largely absent. So this restricts access to long-term project finance that is critical, right, for not only SMEs themselves, but also for infrastructure and industrial recovery. The third challenge that they do mention are the infrastructure and logistics bottlenecks. So the example that I've given you at the very beginning, right, of the industrial cluster, or rather the vision for it, that remained unrealized because of lack of public infrastructure in the vicinity, sort of highlights the pertinence of this challenge, right? So you have a lot of war-related damage to transport and energy networks. Part of this EIB and other institutions are trying to address, and we are absolutely amazed at the speed at which things are being repaired and recovered, but it's still, at the same time, it's not enough, right? Finally, skills and labor shortages are deepening, and we see this even as we are doing our mini recovery projects across different regions of Ukraine. So I'll give you an example from Dnipro, where we're working on a hospital, building a hematological department that is actually going to do some cutting-edge research as well. And here we have a party of 10 workers working on it, right? Which is obviously causing implementation delays, possibly cost overruns, and so on. And there's nothing you can do, because if you're not a strategically important company, you cannot reserve enough personnel for military service, let's say. And given that these jobs are still predominantly performed by men, we acutely already feel some of the labor shortages, right? But beyond labor, it is about skills, right? The Foundation of Olena Zelenska, in collaboration with UNICEF, recently presented the results of a very interesting study about what your young people are dreaming of being when they grow up, right? And you can see that the professions that they're most likely aiming for or choosing are actually not well matched to the needs on the market, right? It kind of reminds me of the situation in Czech Republic and Slovakia after the Iron Curtain came down. And some of you may know that this was described as an absolute failure on the political science profession to not be able to predict that this was going to happen. So I think that created a rush of many young people then wanting to become political scientists. And then we ended up with a market full of political and social scientists, of which I am one. And still without people who would be able to fill the professions that were actually needed. So again, we're returning to this need to think about the economy of the future and also encourage, educate, and match young people that are growing up in this country and despite everything want to stay here and work for its reconstruction and European integration, to point them in the right direction, right? So this is what we're hearing from businesses, and even as working with businesses remains for now a more minor part of what we do here, also the interaction with the huge infrastructure portfolio that we are trying to manage here is obvious. This is where the public and private connect.
Thank you very much. So I'm going to ask the last question, and then we will start a Q&A session with the audience. We will have some time for this as well. And my last question will be to Mr. Klik, and I would like to go back to the issue of sanctions. So, from your perspective, so basically the same question that I asked Natalia, from your perspective, do sanctions work, and can they generally work given the fragmentation and given the lack of unity in the world?
Okay, thank you. Very interesting question. I think the pressure on Russia from the sanctions is material. It's material, but I think unfortunately it is not yet have been decisive enough to have this material shift in the policy of Russia. And we have to reflect a little bit why that is, and that is probably because there is arbitrage. There is arbitrage that is possible, and Mrs. Ambassador has also said on it, it's becoming much more difficult to have this unanimity on the sanctions, and that's exactly what we need. If we want sanctions to work, we need to have a broad coverage of that. We at the IMF, we track, of course, what is happening a little bit in the Russian economy. You should also know that Russia has stopped to publish official data, but we do know some things, and we see it's a war economy. So growth is getting a hit. despite massive investments in military and so on. But growth, the drop in growth is actually due to labor shortages. They have constraints in high-tech imports and also tighter financial conditions. Potential growth is taking a hit because there are no capital goods investment anymore. There is skilled labor immigration, and there are no civilian investments anymore. Another thing is the inflation. Inflation is high. There is, of course, also the current account. The surplus is gone because of the energy exports that have been dropped. It's all about defense that undermines long-term growth, long-term productivity. So less for education, less for health, also an important area. So sanctions work if we can make it a big coalition. And I think that is now the need, what we need to invest on. And I think the Ukrainian authorities are very good in doing that, is in building that coalition to make the sanctions strong. And then ultimately, let's hope that Russia will actually take this strategic shift and face the consequences of these sanctions.
Thank you. Let's hope that we will be able to build this coalition despite all the challenges. Thank you very much. So do we have any questions from the audience? No. You have an opportunity to ask Vice Prime Minister, the EU Ambassador, the IMF Managing Director, the head of the EIB. So please go ahead. Yeah, I see one hand there.
Thank you. My question will circle...
Please introduce yourself.
Thank you. Anna Vlasyuk, Kyiv School of Economics. I have two questions, one to Madam Ambassador and another one is to Mr. Klik. Both questions concern Russian reserves in some way or form. First question to the Madam Ambassador. We know that the deadline for extending EU sanctions is approaching at the end of July, and there were a lot of speculations that Hungary might try to sabotage extension of the sanctions. If you are able to share with us some encouraging news in that regard, and what is EU view long-term? Is there a possibility and meaningful discussions on changing the voting procedure on sanctions and maybe other aspects of foreign policy? And my question to Mr. Klik is regarding possible segregation of Russian funds from the Euroclear into a separate trust fund and reinvestment into other more high-risk but high-yield interests. Thank you.
Please. Let's answer these questions and see if we have more. Would you like to take this on sanctions?
Yeah, I will start. The Russian sovereign assets is actually my favorite topic. I've worked a lot on it. Your question is already very precise. Let's say from where we come. We come from building basically a European legal basis. That's what we have done. We have built a European legal basis clarifying that the proceeds of assets that are held on the balance sheet of Euroclear, that these proceeds are actually for Euroclear. That was the first big step that we had to take. That step has been taken. That's a solid one because we have European legal basis. Second step we have done is that we have taken legislation to actually use the proceeds of those assets to make a loan mechanism and to refinance a loan mechanism from the G7 member states. Was a major step. What we now need to make sure, and that was a question to Madam Ambassador as well, that is that these sanctions, of course, remain, because that was probably the mistake at the time we have used sanctions on sovereign assets from the central bank to put it in a sectoral sanction regime. And we should probably had a separate sanction regime that we don't need to overrule every 6 months. But okay. We have done so far always. So I'm also confident that also next time we will manage to roll over the sanctions. On your particular question, to put then these assets in a vehicle, it was again today in Politico, it's a valid option to think about, because a lot of thinking will need to be done on that, and a lot of thinking has already been done. But what I think as well, if we move, or if one day, because this is a political decision where you need a big coalition, probably G7, G20, because also Global South should actually be on board on such a move to actually touch sovereign assets, the central bank assets. So it's going to be a long process, but what we should not forget is there are also liabilities in the system, and that are the liabilities that are on the balance sheet of Euroclear. So if you move in a direction of an SPV that then can invest more aggressively, higher returns and so on, I think we should also think about the liabilities. And if you move assets from Euroclear, which is a CSD, and you should also think of moving the liabilities to that SPV. So a lot of thinking needs to happen, but I think we should already be very proud on what has been achieved. That is that strong European legal basis that we can actually now mobilize the proceeds of sovereign assets which are immobilized in Euroclear. Let me stop here because otherwise I will continue for
If I may just comment,
sure.
and thank you for making this question. This is one of the things I really wanted to comment in this audience. I think a couple of very important elements that Hungary made a fantastic job, that the discourse was shifted from using the frozen assets to keeping the assets frozen. So that's very different, and I think the effect of this policy of Hungary putting veto on the last extension of sanctions had the opposite effect, and there's been a couple of consultations I had with some of the member states, is that basically the body of frozen assets is so far the biggest leverage European Union has in terms of pressuring the Russia. And it was revealed by Russians themselves, because when the active engagement started at the level of the US-Russian contacts, one of the first points in their wish list were the frozen assets, right? And then, only then we saw all the other things. So that's really important for them, and this what makes US notice European Union, to be very, very blunt. But I think approaching the momentum for the extension of the frozen assets being frozen, the decision on keeping the assets frozen, has led to a discussion that the legal nature of preserving these assets frozen should be changed from a sanction policy and to a specific legal framework for body of these assets. And I think it's a momentum when the nature, and according to the data we receive upon the request we've sent earlier this month, that the nature and the structure of these assets is changing. So it's very important to consider a specific legal basis for these assets, start considering the possibility of concentrating these assets, probably without even speaking right now on using these assets or providing these assets to Ukraine, targeting to recovery. Again, it's a bit more distance discussion. Now we really have to consider that have to accept the fact that the instrument is changing, its legal nature should be changed, and it should be separated from the decision where this money will go, who will use them. They need to exist, and they are, so far, should be considered as the biggest leverage EU has, EU, and then only the G7 countries.
Great, thank you very much. So the last comment from Madam Ambassador.
Thank you very much, and I'll briefly comment on this issue as well. Not many people know the proceeds of the frozen assets was the first step that the European Union actually made, well before any movement by G7. And they are normally associated with the ERA loan and servicing the loan, but in fact, the 2024 proceeds of the assets went to weapons for Ukraine via member states, via something called European Peace Facility, and 1.4 billion out of that, in fact, went through the Danish model to the Ukrainian defense industry. So I think the question is legitimate, what kind of a vehicle ultimately is used, or what kind of a yield you can get on these assets, even if it doesn't touch the principle, because whether you have 3 billion or 6 billion or 12 billion a year is quite a big difference. And I think there is active thinking about that. Now, on your question about the sanctions, yes, it is our panicky reality every 6 months, but we are already now on the 18th package, just approved, so we manage, and I'm quite confident as well that we will manage as well. And then rapidly after that, I think what Olga was suggesting, this move needs to happen. I think that our continental lawyers, I'm one of them, need to get a little bit of fire under our butts to find legal ways to be able to use the resources more creatively, because it is indeed one of the, not that many, but one of the key pressures on Russia.
Thank you. At this point, let's thank our speakers for the excellent interaction, and I guess we will have a coffee break. Yeah?
Yes,
Thank
that's
you
right. Thank you. Thank you for this honest, insightful conversation. Now we have 3 minutes break. Please take your time, but be in time when we will start. See you in 3 minutes. Dear all, welcome back. I hope while I'm talking, people outside the ballroom will hear me and joining us because we are ready to start. European markets to support its recovery and reconstruction. Policymakers, investors, and financial experts will share their views, and I'm pleased to welcome the moderator of this session, David Vavra, managing partner at OG Research. David, the floor is yours, please.
Thank you very much. Ladies and gentlemen, distinguished guests, dear friends, I'm very happy that I can participate in this event. Thank you, the National Bank, for inviting me. I also have the honor of sitting on a board of advisors to Governor Pichny, and I'm very happy that I can welcome you to this panel on financial markets as engines of Europe's development, competitiveness, and growth, which is a topic that speaks directly to the future of the continent and hopefully to the shared prosperity of both the European Union and Ukraine. So as we gather here today, Europe, of course, faces a number of challenges it always had, but now it's perhaps more intense. The long-term productivity growth is low. Financial markets are fragmented. We face urgent need to finance our transition in terms of defense, green, digital. And we have the imperative to support Ukraine in its reconstruction and integration into the European Union. We also face a geopolitical urgency. Today, financial markets are not just about supporting growth. It's not just about efficiency, but it's also about strategic resilience. Europe's economic security depends on our very ability to finance all these transitions, to finance critical infrastructure, being able to finance innovation, defense, and digital. So these are challenges, but challenging times. But perhaps they also offer us an opportunity to rethink of what we seek from financial markets, what financial markets can bring us as companies, people, societies, how to structure them, but probably also how to reinvigorate the trust in long-term sustainable growth. I think that's the very trust that powers financial markets. And without that trust, it's going to be difficult to use financial markets for anything. After all, credit means trust. Of course, overcoming this will require a lot of diligent policy making and navigation. But above all, it will require a lot of capital, and capital deployed at scale. So what are the numbers? The ask is not small. It's estimated that in order to deliver on our commitments in terms of defense, green transition, digital innovation, and so forth, we need additional 800 billion investment a year, which is about 5% of EU's GDP. That's a lot. On top of it, Ukrainian reconstruction costs are now estimated at 500 billion plus, and the bill is ticking. Yet, despite all that, Europe is not short of savings. It's not short of money. European households actually save 1.5 trillion a year, much more than the American counterparts. But unlike, while Americans are able to channel their savings through very deep and liquid markets, that means also very cheap and efficient markets into investments. We Europeans struggle to convert our savings into long-term productive investments. We face fragmented financial markets that are dominated by banks, financial markets that are underpowered in terms of risk and equity capital. As a result, estimated 300 billion euros a year leave the European Union in search for better return elsewhere, mostly in the United States. And this is very saddening, especially considering that at the same time, we have small and medium-term enterprises that in Europe, and especially in the Central and Eastern Europe, eastern part of the European Union, which struggle to seek finance. And these are the very SMEs that in all EU materials are basically designated as the carriers of growth, those that deliver innovation and employment opportunities. And yet they struggle to find finance. Now, these observations, of course, not new. Capital Market Union, as the EU's project, flagship project, was unveiled 10 years ago. And coupled more recently with the Savings and Investment Union, both are bold and ambitious attempts to make markets more integrated, to help finance, to help channel private capital more efficiently into long-term productive investments. More efficiently means also more cheaply. So that's important to bear in mind. Now, some progress has been made, no doubt, but a lot of key barriers remain. We still have fragmented insolvency laws. We have different supervision practices, pension funds. We're not integrated. Cross-border tax treatments of investments is a mess, to name but a few. Now, we are probably able to get through it, but we will need more resolve. Now, these trials give us, well, we should not probably, let me put it this way, we should probably not take these trials that Europe is having as the opportunity to look just at Europe's inconsistencies. Perhaps we should also take these trials as an impulse to seek for success stories. Stories in which the financial market development under the umbrella of EU integration has delivered sustained growth and prosperity. And there are such examples. We already heard today about Poland. We heard a bit about Lithuania, and I'm sure we're going to hear more. I myself am Czech. I come from the Czech Republic, which is a new EU member from 2004. So I can say that these success stories are real. I have witnessed one, especially in the Central and Eastern Europe. I'm therefore very happy that I can invite Alina Slusarchuk to this panel. Alina has been working on Central and Eastern Europe, the financial market in Central and Eastern Europe, but also in the MENA region. And I think she has a lot of stories to tell and a very interesting angle contrasting those that are part of the EU and those that are not. Please welcome Alina. As I already said, Baltic countries present another great example, probably full of lessons for Ukraine and others. And I am really delighted to see Governor Šimkus of the National Bank of Lithuania, that he has decided to join us panel as well. And the lessons that he's bringing, he will be bringing, are going to be relevant for Ukraine, I'm sure, not only because Ukraine has demonstrated such a remarkable resilience in its financial system over the last few years, but it has also demonstrated a will to move on, a will to integrate. I'm therefore very pleased that Deputy Governor Yuri Heleti has agreed to join us panel as well and to tell us about what Ukraine has been doing to be so strong and what what their plans are going forward. And last but not least, Madame Lagarde, in her recent article in Financial Times, I think 2 days ago, she spoke about the fact that that we might look at these geopolitical shifts as an opportunity for Europe to take better control of its own destiny and for the euro to become a truly dominant reserve currency. And it will therefore be very interesting to hear what Vlad Raškovan, Assistant Executive Director of the IMF, has to say about these perspectives and prospects that await us. Vlad, please. So I think let's begin. Each panelist will have about 5 to 10 minutes introductory remarks, after which I'll have some questions, and then I will ask you to ask questions as well. Alina, the floor is yours.
Thank you. Well, first of all, I thank National Bank of Ukraine for inviting me to the conference. I'm really honored to be here. I'm here in my personal capacity, so to use my experience as an economist in the private sector, in the financial industry for all the years, and I'll share my perspectives on the subject of this panel. And yeah, the opinions and views will be that I will be sharing today are my own, and wouldn't be affiliated with my current employer. So, coming to the topic of our discussion, as an economist in training, and by the way, thank you for staying till the very end. I know it's challenging. We had a long discussion. We've heard a lot of great speakers, so we'll try to keep it entertaining, and we'll keep your energy high. Back to my speech. As an economist in training, I'll start with saying maybe very obvious statements. Why we connect financial markets and growth. Countries' growth and economic potential depends on labor, capital, and technology. That's one. Ukraine, after war, will be undercapitalized, and that means marginal return on capital will be very high. That's why it is important to get the capital into the country. To attract capital, as David said, capital is trust. So environment matters. To attract capital, every single line in ease of doing business, in World Bank indicators, reforms, all this environment has to be created for the capital to flow in. Of course, it will matter a great deal how Ukraine security and Ukraine future looks like, how much confidence it has, but it will be necessary but not sufficient conditions. So reforms are important, as we've heard many times today. And and developed financial markets, they help to attract capital from abroad, but financial markets in Ukraine will help to redistribute the capital in where it's most needed in an efficient way. So it helps to attract the growth factor into the country, but also make the most use of it inside. And the deepening, we've talked a lot about risks today, so deepening of financial markets goes hand in hand with developing a macroprudential framework. And here, I thought, as an economist who covers Central and Eastern Europe, Middle East economies, probably the close example is C3 countries, Poland, Hungary, Czech, where of course, Baltic states, but I'll focus on those which I know somewhat better. Bulgaria, where they have a great showcase that the integration is not always smooth, and it bears some side effects. So once banking sector opened, the foreign ownership of the local banks increased. There were a lot of new subsidiaries in the countries, and countries witnessed huge surge of lending in the economy. It does help growth. It does help investment in the country. What we've seen, the wages would be higher, but the external leverage went up a lot as well. So whenever there are huge inflows of capital, other effects on the macro side is widening current account balance, widening external debt, both the government and the corporate sector. That's why what I'm trying to say, there are always two parts of the story, and the regulators, the government has to keep an eye on it. So on the micro level, you will have higher employment, income convergence, technologies flowing in, improvement of business environment, bringing some business practices from abroad. And on the macro level, that's where the hard work of the regulators is. There is a rise of widening current account deficit and steep rise in public and private debt. And that's why the macroprudential framework has to be always in check for the times when and if the capital inflow stops. Now, I will just mention that on the state of European financial markets and the Central European markets, they are still mainly financed, as David said, by the banking system. These are mainly loans, and this will be loans to households, say mortgages, loans to corporates, and Europe and say US are very different from sources of funding. So in US, the role of security market, the stock market is much bigger. So that's why when European develops its financial market, it's good to look at the examples across the globe and see what model fits it better. So for the sake of time, I'll stop here and pass it back to you. Thanks, David.
Thank you. Thank you. Yes, this topic that financial market development is necessarily pro-growth, pro-prosperity, that we kind of take for granted. You rightly said it has two sides. Few other speakers today, I think two alluded to that as well, that there are also darker sides of financial market development. And so maybe that's a topic that we're gonna come back to later. Thank you. Gediminas, what's your view?
Thank you, David. And ladies and gentlemen, dear friends, first of all, I would like to thank for invitation to this conference. It's my great pleasure and honor to be here. And I'm particularly pleased to see how the partnership between the Lietuvos Bankas, Bank of Lithuania, and Nacionalinį Bank Ukraine, National Bank of Ukraine, continues to grow in substance, and relationship has deepened meaningfully in recent years through mutual cooperations and visits. The topic we are addressing today, financial market as engines of Europe's development, competitiveness and growth, I think it's very least to say, it's very important. It's of substance, I would say, it's vital. And I will begin my contribution through the lens of three paradoxes. First paradox, it has been mentioned a couple of times already today, that European economy is broadly bank-based, and yet access to credit is becoming increasingly constrained. So let's take corporates, for example, and they are traditionally the core clients for banks when it comes to financing capital investments. But today, bank lending to corporates as a share of GDP is either stagnating or, in fact, declining across many European economies. Even more, traditional banks are often ill-equipped to serve the needs of small and innovative startups, in other words, companies. And this is an area where venture capital tends to have a comparative advantage. Many reasons for that, many reasons. And it's because banks in Europe are less profitable, they are smaller in scale, they use less securitization than their counterparts in other parts of the world. But the fact is, in the bank-based system, we have less bank loans available for companies. The second paradox, I have not counted how many times today the single market has been mentioned. So when we talk about the EU, when we talk about the EU accession, they basically are referring to the accession to the single market. And there is but. But internal tariffs for services trade in general and financial services in particular are very high in this single market. Tariffs is the topic. Once again, it's in headlines, in media, and it's because of this global policy debate. The United States, for instance, has recently increased the effective tariff on imports from the EU from around 2-3% to just over 10%. And that's a significant jump. But if I refer to the financial services within the EU, so the IMF made calculations last year, and they show that financial services trade within the EU faces barriers that amount to, was that figure mentioned today? Probably not. 100%. Of course, it's not a tariff, but it's in a way the obstacle which can be, so to say, converted into the tariff equivalent terms of 100%. And the staggering figure reflects lack of harmonized rules, persistent legal and regulatory fragmentation, and deeply entrenched national frameworks. Okay, so what is the third paradox? This one has been mentioned, I think, today. EU is rich in savings, but poor in productive investments. And there are many structural issues on this topic. The persistent shortage of long-term capital, the absence of true EU-wide safe assets, the wide divergence in supervisory and regulatory practices across member states. And the reports published last year by Mario Draghi and Enrico Letta have laid out these challenges very clearly, and they very well revealed the urgency to address these issues. But I would like to address here the geopolitical consequences, because they are the following. If we have capital, and if we cannot turn them into a productive investment, then as a result, we find ourselves relying on importing advanced security and defense technologies from abroad, which is important strategic vulnerability in an increasingly harsh geopolitical environment. And that was just the beginning. The question might arise that why I make this discussion here in Ukraine. And I'm doing this because I think Ukraine's experience is of value to the European Union, as the European experience is very valuable to Ukraine. And let me start with Ukraine's experience, how it is important to the EU. And Ukrainian experience tells us that we need to change our approach to Europe's financial markets. Russia's brutal war against Ukraine unfolded rapidly and in ways that few have anticipated. Recent escalations in the Middle East is yet another sobering reminder of the deepening geopolitical instability. And in this context, financial markets are not just vehicles for growth and competitiveness, but they're also about resilience, about security. And Ukrainian experience tells Europe about the need to turn the financial markets into enablers of our geopolitical resilience. Easy said, but how to do it? Just a couple of thoughts. One, unlock investment in dual use and security-linked sectors. They have long been underfinanced in Europe. And let's be clear, it's not about the militarizing finance, but it's about giving Europe the tools to finance its sovereignty responsibly. Second, update sustainable finance rules to reflect today's risks. Environmental risks are very important, but as important are geopolitical risks, and our capital markets must be able to support critical defense sectors alongside the public ambition. Third, borrow jointly to finance defense. Recent initiatives such as the proposed SAFE, that is Security Action for Europe instrument, mobilizing up to 150 billion euros, is a very promising step in this direction. And the fourth idea is, while financial markets play a central role in enabling open strategic autonomy, we must not overlook the role of public finances, of national public finances. And for instance, in Lithuania, our analysis revealed numerous tax exemptions, the streamlining or removal of which could create additional fiscal space. And these revenues are not essential just for reinforcing national security, but they also bolster the investors' confidence in the sustainability of the public finances. In the last part, what is the European Union's value to Ukraine? And I will borrow a line from the Aerosmith rock band song. They sang, "Life is a journey, not a destination." And if I adjust it a little bit, integration is a journey, not a destination. Guarding own financial markets, choosing for opt-outs, asking for transitional arrangements. So throughout the EU's own integration, we've seen how national interests often accompany the path towards deeper unity. And this is very much politically understandable, and yet too often they slow progress toward a truly unified economic space. And let's take banking union as an example, and despite years of negotiations, it still remains incomplete, largely due to national reservations about establishing a common deposit insurance scheme. Let's be clear, the greatest asset, the greatest economic asset of European Union is the single market, a market which is open, competitive and cohesive. And that is why it's especially important to raise this point here in Ukraine, a country which has very clear European ambition and target, and an increasingly central role in the future of continent's economic architecture. So when every country guards its own financial structure at the expense of the coordination, the single market is inevitably weakened. And the opposite, when the single market is strong, we all benefit. Growth accelerates, investment thrives, and resilience strengthens. So if I may leave with my discussion with only one message today, it is embrace the European journey. Lean into the process, even when it means adapting national regulations, modernizing supervisory institutions, or rethinking long-held financial practices. That means striving for fewer exceptions and more ambition, not just alignment for the sake of accession, but integration for the sake of the prosperity, resilience, and shared growth. Thank you and дякую.
Thank you for a very well-grounded exposition. Listening to you, I began thinking that the European project, the EU project as such, probably kind of stopped halfway. You know, the single market is a free movement of goods and services is halfway through. Capital is not freely flowing. That's the subject of this conference. Peace, that is the cornerstone of the EU project from early 50s, is now being shattered here in Ukraine and as a threat a dormant threat over the entire Europe. A free movement of people, probably guaranteed, but COVID itself showed us that it's also not absolute. And therefore that may kind of bring some uncertainty in the population about these core values. So we're basically taking our message in more general terms, like returning back and finishing up the job is what's ahead of us. Thank you for this. Yuri, may I ask you what have you what do you think of Ukraine and its resilience and capital sector resilience, especially, please?
Ukraine experience over the past more than 3 years of the war has tested every aspect of institutional and economic architecture. Financial system was affected. What is crucial for us in order to safeguard resilience in this environment of extraordinary pressure? First of all, is trust in the confidence of market in the national bank and how we can fulfill this. First of all, by effectively implementing our mandate. And our mandate, despite the war, remains as unchanged, is to safeguard price and financial stability. And we successfully are achieving this. In response to the challenging environment, we have adopted tools. We adjusted our policies, approaches, and almost monthly, weekly, we have to analyze different aspects of our policies and try to address existing threats and risks. A striking example is our monetary policy. Do you remember when the war started, we fixed exchange rate, we decided to impose strict currency controls, abandoned inflation targeting. It was needed in order, first of all, to maintain control over the financial system, to stabilize the situation and avoid panic. Important area during these 3 years is our cooperation with government. You know that in 2022, we made difficult but deliberate decision to provide monetary financing. It was only 1 year in 2022. From 2023, we stopped this. And we developed another set of measures to support debt market and to help Ministry of Finance to raise capital. What is crucial for us? First of all, is independence of the National Bank, is communication with the society, and implementation of our mandate. When situation improved, when we understood that these anti-crisis measures are not long-term solution, we decided to implement actions to mitigate risks associated with the war. First of all, in 2022, we increased key policy rate in one move from 10 to 25%. We decided to make repegging of exchange rate. We liberalized in 2023 and last year and this year as well some fixed controls. Introduced as well some unorthodox tools to protect public savings. Crucially important is to have a firm position to protect our mandate. Frankly, it was not easy during the first year of the war in our communication with the government. But what is important to emphasize that mandates of the National Bank is treated by government with understanding. They understand our goals and when we can provide some help, assistance to the government. What is crucial for us nowadays? We have to be proactive, and in this case I refer to capital market infrastructure. Taking into account that more than 500 billion is needed for reconstruction, as you mentioned, that is estimate from World Bank. We need to develop architecture inside of Ukraine, to have institutions, technologies to attract, to raise this capital. You know, the National Bank is a shareholder in Settlement Center, as well in National Depository, Custodian. We started discussions back last year with international partners, and we achieved considerable progress. Soon we're going to finalize action plan of our capital market infrastructure development. Our priority is to establish holding which will consist from new stock exchange, settlement center and national depository, and invite EBRD and strategic investor to be shareholders of this entity. It's crucially important for us, first of all, to have the best international experience in terms of technologies, digital solutions, to show EU, to show other countries that we have proper solutions. As well, important stream is our cooperation with Clearstream, and we extended the link. You know that back in 2019, when we started the link between National Bank and Clearstream, we managed to raise more than 120 billion as of 2020 of non-residence investment in Ukrainian governments. It was around $5 billion US dollars. We extended this year this link to municipal bonds, corporate bonds, and hopefully this channel will be used to raise capital, which is highly needed and will be highly needed for reconstruction of our country. What need investors? First of all, is confidence, as I mentioned, to the policies of the National Bank, predictability, and very good anchor of our predictability of our macroeconomic policies is our program with IMF. We, as Ukrainians, we have to be proactive. We have to develop initiatives to show our courage. We understand that we have leverage from international community, but we are main players, main drivers of our prosperity, and we have to act very actively. National Bank is ready to be driver of many reforms, and one, as I mentioned, crucial for us is capital markets infrastructure, and hopefully soon we will finalize this initiative and materialize our strategic views with strategic investors, with EBRD. And let's focus on other, and I will deep dive a bit later into details during this panel discussion, what are needed as well to attract private investment, to raise deposits, to channel these deposits into productive lending. It's crucially for us to have, and it was mentioned today by Madame Lagarde, to have productive investment, to increase our export potential, to avoid bubbles in this area, and in order to mitigate these possible risks, National Bank will act proactively. We have capital controls. We understand that many investors need free movement of capital, but we have to protect our reserves amid this geopolitical uncertainty, geopolitical risks, and having this crazy neighbor. That's why priority is clear for us, and we have to act to speed up the process. After the war will finish, we need to have proper infrastructure in place. We do not have time.
Thank you very much. It's kind of fascinating because you could quite legitimately, I could imagine this conversation taking place somewhere else and by someone else who would quite legitimately could say, well, we just demonstrated our system of government and organization is really superior, it's really very resilient, so don't fix what ain't broken. And yet you understand that this is just a beginning of a journey, and you relentlessly work on moving on. So that's I find fascinating given the experience that you have since the full-scale war broke out. Vlad, what do you think?
First, maybe it's not easy to speak on the last panel of the day, especially before the dinner, to keep the energy of the people. But at the same time, it's also a possibility to leverage on what was said before. And I want to borrow some concepts, from today's speeches. And the first probably would be from what Jacek from Narodowy Bank Polski was saying about narrow corridor, especially if this is my favorite book of Darana Jemoglu. And also what Gediminas now said about the journey. We really try to enter that narrow corridor, and we also try to enjoy that journey. And I just want to recall and remind to some of you, and David, you are one of the witnesses of that, like 10 years ago, while we were developing the vision of the National Bank of Ukraine that time, and it was just after the Revolution of Dignity, we put one of the elements of the vision is that National Bank of Ukraine wants to become a member of the family of European central banks. And look where we are today. You know, we have a governor of one of the European central banks speaking on the panel. We had another former governor of one of the central banks speaking. We have one of the most famous European, the governors of the European banks was moderating the panel. We had a president of European Central Bank speaking on the panel. And this is the journey which we went through, and it could be not probably imaginable, 10, 11 years ago. But also 10 years ago, I had another event. I was speaking in Brussels in the European Commission in front of the Commissioner Hahn, speaking about the banking sector reform, financial sector reforms, which we were planning at that time. And I remember how the Commissioner Hahn said, this is a historical event that Ukrainians in Brussels speak about the Ukrainian banking sector reforms. And I immediately responded, it will be historical when Ukrainians in Brussels will discuss the European banking reforms. And look where we are. We're not in Brussels yet, but we discussed in Kyiv. And we discussed the European market, European capital market, and the question of the euro adoption in different countries. So we try to go to this journey, to enjoy this journey, and to get to that narrow corridor. But as the Governor Pishnis also said, we need to run faster. We don't have another 10 years because we face also existential risks. And while we try to enter that narrow corridor, we need to admit also that this corridor is attacked. And is attacked first, by East, by the Russia, and most recently even attacked from the West, of Europe. And this is also interesting. And I think Europe, we need to admit, all of us need to admit that Europe is afraid to admit that Europe is in a war. Europe is saying, yeah, we don't want to be engaged directly, but you are in a war. Gediminas and Vitas and Stefan, you are in a war. Russia attacked you, more than 10 years ago, and attacks your narrow corridor of the democracy, of your economy. Just think about how Russia tried to elevate the energy prices, how it led to the spike of inflation, how it attacked your institutions, your society. And let's not be surprised with the rise of the ultra-right parties in Europe and also rise of the Euroscepticism, about which we also spoke today. And Russia is, unfortunately, sometimes can be successful, is poisoning these European nature and European aspirations, and also sometimes even corrupting some states of Europe with cheap gas. We saw it in our past, and now the Russia is trying to do like that. And there are solutions for that, and we already discussed many. I think in each panel, people were saying about single market. Speaking about the common banking union, the security capital market, about the eurozone, these are solutions, and these are solutions which are raised and shown in the reports, as already mentioned several times today, of the Draghi report. The governor was saying about that. Letta report, Enrico Letta report, also was said about that today. But guys, let's stop talking. Let's doing something. It's nice to talk about the issues of productivity in Europe, about the regulation, about the single market. But the reports were last year. We are not closer yet to the single market in Europe. And again, going back to these at least 4 elements, the single market. The single market is, for sure, has still problems with, you said about tariffs, for sure also internally. We need to have less barriers, less internal barriers. We speak about the fragmentation, mostly meaning West versus East, but in reality, there is a big fragmentation in Europe. And the Letta report is actually saying that we need to have integration within the European Union, in energy market, in telecom market, and also about financial sector. And, going back to the common banking union, I used to work in Italian group, for almost 10 years. And this group was trying its slogan was truly European bank. it has never become a truly European bank. It was always Italian bank. And, you know, almost 10 years later, when I listened about the UniCredit attempt to buy Commerzbank in Germany, and the German authorities in the previous administration saying we're against the Italian bank to buy a German bank, I mean, there is no way, you know, to compete with Bank of America or with JP Morgan if you still have Italian banks. If you think about, and I remember in 2006 I was participating in one of the projects about the merger of UniCredit with Société Générale, you know, the major topic will be where will be a capital, the head office of the bank. French will never allow this to be in Milan, and Italian will never allow this to be in Paris. Guys, it's Europe, you know, as I already said today, I think by Olga Stefanishina, it's not about only French and Italians. We really need to look at this as Europeans, and the banking sector, you know, you have a lot of this fragmentation, a lot of Italian banks, a lot of French banks, a lot of Scandinavian banks. We don't have truly European bank, and this is a problem because the needs, even like look at the projects like Free Seas Initiative, a lot of big infrastructure projects, now the military projects, they will require big capital. You know, US has it, and unfortunately European banks are pretty small. And this is the situation, going back to the capital market. You know, the capital market, as IMF is saying, is a critically missing element of the European productivity and European growth, because it's not a secret that the European sector, European economy is really more led by the banks. But as the governor said, you know, the banks, the access to the credit in Europe became more and more scarce and more limited, and also for corporate, and a lot of analysis on that, while the savings are there. You know, you mentioned, David, about that. So therefore, the capital market is an important element. And look at the recent, you know, Paris summit on artificial intelligence, when, you know, everybody tried to show at least Mistral, you know, to raise at least one company to be competing with all the, you know, the avenue of the both Chinese and American IT companies, which have a capitalization 10, 15 times bigger. And the company like Mistral, which is a good production, good researchers there, but they cannot attract a lot of capital because there is no capital in Europe for that. There is no capital market. There is no very well developed venture market in Europe. And therefore, they cannot pay enough for the talents. They cannot enough pay for the NVIDIA chips, etc. And without that, as we know today, without the IT, without the solutions, the data centers, which they need to build, you know, the CEO of NVIDIA was in London in last week on the tech summit, also saying that UK can play, but it's more like a, you know, like a call to everyone, but not a solution yet. You know, Letta was saying in his report also about the creation of the saving and investment union, you know, on top of the capital union and the banking union. Speaking about euro adoption, you know, this is maybe more complicated rather than even banking sector and capital market, because it's a double-edged sword for sure. And Madame Lagarde was saying about that, about the European open economy. It's about trade. It's about the trade not only of goods but also of services. And for sure, the common currency, and we know that it brings to the lower transactional costs. It's more stimulating trade. It's reduced FX risks, which are important in the cross-border trades. It's, you know, motivates or incentivizes more incentives. But at the same time, and I think Vitas was saying about the experience of Lithuania from 2007, you know, that, you know, thanks God that you did not, you know, accept the euro that time because you missed inflation target. But in reality, this is a problem also. The central banks are losing their independence in monetary policy decisions. It's also the question of this is like a one solution for everyone, and sometimes still the problems could be different in different countries. There is also cost of integration, but still, as we know, the benefits of the Eurozone are higher. And I think it was one of the mistakes, you know, while the European Union was developing, that it was not going hand in hand, you know, the Eurozone together with European accession. Because I agree with many speakers today that European accession was more political process and only later economic. Even now, we try to show it was an economic process. But while I said about these four markets, I should mention the fifth one, And the fifth one is, as we say, as we joke, maybe sorry for this word, in Ukraine, that the best instrument for monetary policy is a good air defense system. And this is true. And all of these about the capital market, banking sector, etc., if you are tomorrow, if Europe tomorrow is in a hot war like Ukraine today, all of these will be much less important. Much more important will be your security system, and you said about that. These costs are very much important, and therefore, really, European Union should reinvent itself. First, and the Madam Ambassador Katarina Materna was saying about this Danish model, how to finance now the production of the security solutions, drones, etc. The Madame Lagarde was saying about that. Ukraine can do this today, so you really need to find space in your budget, in the 7-year budget, to finance Ukrainian security, because factually we are your today air defense system. And you need to find a way to support us. And this way, it was mentioned today, Jeroen was saying about that, Katerina Maternova, about the Russian assets. Russian assets is one of the instruments. We need to say about future potential like taxes for oil, some duties for that. And in the end, it will come anyway to some financial solutions. Because even the Russian assets, while we will be able to take it from immobilized, you need to put it somewhere to some vehicle. And these vehicles later to be put on the financial market and to use the financial instruments to finance Ukraine and Ukraine reconstruction. But this is already another topic. Anyway, Russia must pay for that, for the future, for our reconstruction. And again, we are enjoying our journey, and I'm sure one day we will become a member of European family fully, and we will speak in Brussels about our common European problems. Thanks.
Thank you. Thank you. I wonder, I'll start now with the discussion. So I wonder whether Alina and Gediminas would like to comment on the importance of the euro adoption that Vlad had, because today still we have about almost 100 million people in Europe who do not enjoy common currency, and so I would really be interested in hearing your view. Because no one had really mentioned today the euro adoption as a part of our work in integrating European financial market, which kind of motivated my question, and it's kind of interesting. So is it a side project? Is it something that is much less important? We really need to get on with other stuff first, and then go back to, or we can do it in parallel, or it's not that important at all. Please, Alina Gediminas.
Well, what I say is many things have to happen before that. So it is true that many EU members, so they are part of the European Union, but they are not part of the Eurozone, and they are either economically, financially, or say psychologically not ready to make that step. It matters, of course, a great deal for the policymakers. Say, thinking about less so much of Poland, it's a more closed economy, more driven by domestic market, but say Hungary, Czech, very small and open, very open economies. And there, first, like FX matters for inflation, but it also helps them to be another adjustment tools whenever their say trade balance moves. So I would say it would be great if we're here in a couple of years and seriously think about it for Ukraine. But currently, I think it's on the right track, especially in banking and the financial sector. It's like that's one of the areas where Ukraine is the closest to the EU standards. But many more integration steps have to be done before you give away this tool of adjustment. Yeah.
We need to be clear on this. Maybe some time ago we could discuss euro adoption as something separate from the EU accession. And I think Sweden is one of those countries which has this privilege, But now, EU accession is first, but the Euro adoption is the next step and is in a way compulsory part of it. Of course, there are many political things and phenomena and developments and everything, why it takes longer than shorter in some countries, but it's very much, so to say, about the same thing. As for Euro adoption and the integration of the financial markets, well, again, it's very difficult to disentangle those two, but I would say from the capital market integration perspective, Euro adoption, I would find it even more important because like having or being in the Eurozone, it's in a way for the countries as Lithuania was and is, and for Ukraine as it is and will be, and for many other Central and Eastern European countries which has adopted the Euro, is being in a prestigious club. It's a sign of quality in a way. And somebody may like to discuss the independence of the monetary policy and how it changes with, being part of the European central bank system. But at the same time, when you think from the financial market integration and from the investor's point of view into your country, which wants to, when they want to invest, it's, of course, it's in a way that it's a sign or a signature for the country that it falls not only under all the EU legal framework, but it falls under, so to say, broad governance and stability, this, let's put it, framework, which is prerequisite for being in the monetary union. The other thing I would like to mention in this, that we talk a lot about deeper financial integration, but it will yield only limited benefits if it is not accompanied by the truly single market and then consequent Euro adoption. And why I'm saying this? So, for instance, in Europe, I think this comes from the Mario Draghi report, so maybe I'm not be quoting the right numbers, but the EU currently attracts only about 5% of the venture capital funding, while China and the US more than 40%. And like the typical explanation is it's because the Europe's capital markets are less developed, etc., etc. But the issue runs deeper. It's about the single market and its integration, its development, because companies, in order to grow, we need market size. We need a more consistent regulatory framework. And that's the reason why many European startups, the ones that is fast growing, eventually they move to the US where they have those benefits.
Thank you both very much. We're talking about conversion of idle savings into productive investment in the European context. Yuri, what about Ukraine? I mean, Ukraine has a lot of inflows of foreign funding right now, but it's also, of course, uncertain from year to year. But there's also a lot of savings that is being generated, domestic savings. And so are we planning to tackle this issue here? How are you planning on mobilizing domestic savings in the Ukrainian context into productive investments? So what is the role of domestic banks? What is the role of other parts of domestic banking system, financial system, like pension funds, for instance? What do you envisage as the role of a state, central bank, or IFIs, please?
As Ukraine continues to defend independence and rebuild its economy amidst the realities of the war, the question how to mobilize domestic savings, financing, and channel them into productive lending has taken, for sure, new strategic urgency, and is an important question as well for the National Bank. what are the main preconditions to increase savings and to increase lending? For sure. First of all, stability and trust in the financial system. There is no savings, and without savings, no sustainable credit. Our banking system is resilient. Today we are seeing strong deposit growth. We see recovery in credit activity and decline in NPLs. This renewed momentum is supported by a mix of market-driven lending and targeted state-backed instruments, for example, like credit guarantee schemes. It's important to note that the role of direct state subsidies like 579 business lending program is gradually decreasing, while mortgage lending remains largely driven by state-supported program EOSELA. But we are also, as National Bank, preparing for the future. As condition will allow the National Bank, for sure, will begin to roll back wartime regulatory measures and return to fully rules-based framework. And this will be done and will be based on bank compliance with EU-aligned capital requirements, the results of resilient assessment, and as well, it's important to take into consideration that the banking system has dual role. First of all, the banking system has to provide real sector lending. On the other hand, it's important to provide financing to domestic debt market. It's important in terms of fiscal deficit. Stability and trust as a foundation. Important is to have strategy. As you know, last year, Financial Stability Council approved new lending development strategy. This marks a shift from short-term stabilization to medium-term credit market recovery. And the main focuses of the strategy is, first of all, is targeting subsidized lending to critical sectors during wartime, and as well as support of digital credit infrastructure, introducing proportionate supervision for banks. As well, we must be prepared as a national bank to adjust our regulations, macro-prudential regulations, in order to, maybe in some cases, to decrease risk weighting. It all will depend, and first of all, based on our dialogue with business community and banking community as well. What is crucial is to unlock unlocking domestic capital is to have clear understanding that banks cannot act alone. It's important to improve insurance business and to try to create a pipeline of institutional savings and unlock additional potential from insurance business, pension funds that can fund infrastructure, housing, and green transition. Of course, domestic capital is only one part of the solution. We count on international support, and Ukraine's recovery is long-term. Integration with Europe requires international partnership. It was already developed the risking programs, blended finance facilities. These efforts, with the help of IFIs, definitely will help to reduce the cost of capital and raise the quality of financial intermediation. But beyond capital, our international partners also help to bring standards. Strengthen corporate governance is crucial and important precondition for attracting foreign investors. The role of state. In a time of war, some level of state interventions is necessary, is clear, but our long-term philosophy is the following. The role of the state must evolve from being an operator of credit to being an enabler of market-based lending. This means that using credit guarantees and concessional schemes to absorb early-stage risk, empowering state-owned banks to act strategically without crowding out private players. It's important to create digital transparent platforms to assess the finance. By focusing on de-risking, not distorting, we aim to build a financial system that is competitive, inclusive, and market-driven.
if you don't mind.
Yeah, please.
I usually say that we need to have a conflict on the panel because otherwise it's not interesting. And I would tend to disagree now. I need to disagree with something. I would not disagree with Jura. I will disagree with a question. Because I think it's not 100% relevant as of today. Just think about two figures. The Ukrainian reconstruction needs the minimum amount, which is identified by the World Bank, is more than $500 billion, which, by the way, the figure was more or less calculated 3 years ago by Yura Gradnichenko, Ilona Sologub, and others in the first CEPR report. The total loans of Ukrainian banking sector, corporate, retail, are less than 30 billion. It's irrelevant today. The banking sector today is irrelevant for reconstruction. It doesn't mean it should not be, relevant. But as of today, I mean, if you rely only on the banking sector of Ukraine, on savings of Ukrainians, we are nowhere in reconstruction. Therefore, there is and let's be very frank, the challenge which we have today in financing of reconstruction is something which Europe and the world has not seen for a while. So we have very little comparative cases. Therefore again, as I said, we need to reinvent something. We need to invent some new solutions for that, including capital market, banking market, etc. But in the end, the sequence in more or less similar cases coming from natural disasters and the wars, first come with some sort of relief funds. This is UN. We already passed that type in 2022. Later, you come with a trust funds, like from World Bank. World Bank has trust fund. European Investment Bank, European EBRD have trust funds. The European Commission built that. This is like when you get some donors' money. And again, we are using this funding now through the World Bank trust funds. This money coming to Ukraine. European facilities, some sort of that instrument as well. Later, you come with, and we are more or less still on this stage. The third is coming from concessional funding, like EBRD, EIB. We have the head of EIB here, the DFC and others. We are, let's be very frank, even there we are not much yet, because a lot of EBRD loans, they are going not for reconstruction, but for the customers which they had before, so they're more supporting their customers. EIB today said also they are supporting government rather than private sector. And when we speak about 500 billion, and I believe the amount will be much bigger, in the end, because if you add the integration to Europe, is not only the reconstruction, the amount will be probably, $1 trillion. We will come to the situation that majority of these will come from private sector. But before private sector will come through capital markets or banking sector or savings, there are some kind of trailblazers should come, and the next level from the concessional, next layer after the concessional lending is coming with guarantees, and we are not there yet. Because MIGA, the EFC, they show the current situation of the global market show that there are no solutions for that. Because MIGA can finance how much? $200 million. And we need hundreds of billions of dollars, so there is no solution yet. And in 3 years, we didn't invent anything. And I remember, I'm not mentioning now Morgan Stanley, I'm not mentioning JP Morgan for sure, I'm not mentioning BlackRock, but those are organizations which were asked even to design some instruments which could be helpful for us, and we are not there yet. And only after that, they're coming with a blended financing where the private sector, starting coming with a concessional funding, and we partially have today with the Pillar 3 of Ukraine facility, where there is again, so far is EBRD, EIB mostly coming, and CEB Bank, but we need to also go more to the private sector. Later the capital markets are coming, later the venture funds are coming, with a risky funding to Ukrainian economy, because the capital, it has different risk tolerance levels, and to expect that tomorrow everybody will be super happy to finance Ukrainian reconstruction is just useless. And therefore we will not reinvent the wheel here, while we still need to invent some instruments, new instruments, for the market and the Europe. And in general, the West, G7, probably, to go a little bit further, we have today so-named Ukrainian donor platform, which is Minister Marchenko was mentioning about the 13 meetings we have, and the 14th will be on the July 9th before the Rome conference. But this is still a club to talk, to chat. And we need to convert that club to talk, where today already 100+ people coming, every 40, 50 days, from 20+ countries, plus 8 different institutions. And it's a pretty good structured discussion, but there is no decision making. These people are not, writing the check. So we need to have someone who would write the check, and therefore we need to convert this UDP platform towards something which was during the Marshall Plan ECA, the Economic Cooperation Authority or Agency Administration, which was actually coordinating all the support. We don't have that. We don't have our Marshal, Mr. or Miss or Day Marshal who could, take a flag in Europe of Ukrainian reconstruction. We have Ursula von der Leyen, who is taking in our accession, but we don't have yet for the reconstruction. We have IMF for the general support, but we don't have that. And to expect only that the banking sector will support, this is, I think, today is not relevant 100%, but for sure I agree with your question. This is correct, and the National Bank is doing right things, the Ministry of Finance are doing right things in order to activate the local market. The problem is it will be not enough, and before that it should be done many more steps.
Right. So one lesson is that even though it may not be relevant for several periods ahead, the central bank and the authorities of Ukraine should not abandon the attempts to develop the same things that work somewhere else: money market, a government securities market, pension funds, yield curve, to have basic elements, even though the actual capacity of these elements to create credit that is needed will probably not materialize anytime soon.
Pension funds will not create new credit. Pension funds, when they will be created, they will first they will invest money to treasury bills.
Which is also needed.
Which will be spent, for the budgetary support. Yeah. This is important. One day next, yes, and we need to develop, and because we need to resolve also the problems of the pension system in general, and this is, avoiding this problem, is a problem, itself.
Right. Looking at my watch, I think it's time that I invite our audience to ask questions. And now you're battling the late hour. There's no question. If there's no question,
no, there is one. There is one there.
Oh, that's good, because otherwise I have another question. So.
Thank you. I'm very sorry that I was late for this panel. I was stuck in the Cabinet of Ministers. I am Maria Chibanova. I'm the head of the Financial Policy and War Risk Insurance Department in the Ministry of Economy. And my question, I'm sorry in advance if it has been discussed at length, but how, in terms of how Ukrainian capital markets and financial sectors moving forward, how shall we try to find the right balance between the state participation and encouragement of the private sector? My question comes from having already such a large share in the banking sector. At the same time, we see that the state banks are in fact coming back to sort of Vlad's point. State banks were in fact the first banks to join, for instance, our 579 program, which started to stimulate the banking lending in the times where there was complete and utter uncertainty with regards to macroeconomic development. So after that, more banks came, commercial lending picked up. So we have currently sort of coming up possibly the same issue of whether it should be the state mortgage institution testing waters when it comes to securitization and covered bonds, or should we wait for the banks to, to do it first? I'm not, of course, saying of risking a lot of state capital. I'm saying in terms of operationalization of these instruments. Should the state take on this role moving forward, since it's not currently in place? Or should we find ways to stimulate the private sector to do it? Thanks.
I think we need to stimulate private sector to do it, and before that, to privatize several state-owned banks. In this case, they will be private and they will be incentivized, to participate there, because there is no reason to keep 60+% of the banking sector in the state hands. It was an important step, as Yuri was saying, in some moment of time, because it was a crisis resolution mechanisms, both in 2016 and later, in the nationalization of Russian bank. But in reality, we need to incentivize, the government, to sell the banks, to have a private capital. Hopefully, this capital will come from the, international markets, meaning like to have, you can have a Polish bank coming, as we discussed on one of the previous conference. The all Ukrainian banking sector is less than one largest Polish bank. Maybe it could be Turkish banks may come because they are interested in Ukrainian reconstruction. Maybe will come, some European banks coming that, and there are several banks easy to sell on the market. Maybe like Oshad Bank is a little bit more complicated. Even Privat Bank is more complicated, but still to be targets. Maybe Exim Bank should stay in the hands of the state. And these banks should be, privatized and used as a capital. Also, we discussed this for some time in the past, that there is a need to be more consolidation of the banks, the local banks. We still have around 60 banks, while 20 had a 95% plus of the assets, while the small banks, they don't play, and they will not play any role, and they will not become any even targets for European banks who will hopefully want to enter the market, because I believe there is a space for reconstruction. Because, as I said, there will be a lot of the construction projects, and there will be a lot of the European companies, maybe less American, but Europeans and Turkish companies, maybe Saudi companies who will come, for Ukrainian markets, and they would like to, like it was in 90s and 2000, they would like to benefit from having their own banks and trusting, respecting the banks. We should only benefit from that, and I believe with that they will bring the instruments. The problem is, as we discussed some minutes ago, there is no European banking market itself, but hopefully with that we will also contribute, to building up a European market where Ukraine will be also part of.
Anyone else? But we're short in time, yes?
Yeah, I may try to answer. Probably I'm the one who knows the least about the specific Ukrainian situation, so I'll be more general. So first thing, I do believe that there are some areas in financial sector too where state-owned institutions can play a role. So for instance, in Lithuania we do have a state-owned pension annuity fund. Or I do believe that there should be an option for people who compulsory accumulate for pensions to have a state-provided option. Or there might be a state development bank, if we refer to the banking system. Of course, it's not it's a very special bank which tries to solve the, so to say, the gaps in the financing. So having said this, I would raise the other questions. How come the state-owned bank, like a commercial bank, can compete with the private institutions? And if the bank, state-owned bank, can really compete with a private-owned institution, so what's wrong then in the system? And I think this provides an answer to the question you asked, because in a way, if you have good legislation and you have good management and governance in the banking system, it's very hard for the state mentality or to organize the business in such a way that we eventually could compete with the private sector mindset and thinking.
May I have two remarks. First of all, during the war, I believe state-owned banks are important contributor to financing fiscal deficit. And as our experience in 2023, 2024 showed, they contributed the main part to debt market. On the other hand, we have the following problem. The first state-owned banking sector strategy was developed in 2016. I remember this, I used to work in the Ministry of Finance and was responsible for developing the strategy. Unfortunately, since the time, it's almost 10 years, we have not managed to proceed with divestment. I believe that after the war, it's important to have strategy how to divest. It will be appetite from foreign investors, as Vlad mentioned. And in order to have proper banking markets, we need to decrease stake of state in the system, for sure.
Thank you. Our time has come to close, but let me ask one more question, the final one, and I would like really very short, either yes or no answer or this type. So, imagining going back to the core of our panel, will Europe make it? In other words, imagine the European financial markets 5 to 10 years from now. We'll be sitting in the same panel, discussing the same issues, or will it have been over us?
Last October I was speaking on a panel in Bocconi with Mario, with Enrico Leto and Mario Monti, the both former Prime Minister of Italy, and we discussed EU and we discussed the Letta report. And I was invited there as a Ukrainian, and after that Enrico Letta asked Vlad, and after all of this, what you heard now about problems about Europe, you still want to enter European Union? And I said, yes, we do, because we will become European Union stronger, and I believe in that.
Well, the honest answer, I don't know. But I may try to improvise. I think the developments, the things we are experiencing now, probably, I think they are game changers. But the effects gonna be seen not in 5 years. We'll see all the effects, all the impact, all the results of all the initiatives which have been started, not in 5, but I would say in more or in a bigger number of years.
I hope the situation will be different. In a way, in this discussion, we moved gradually during the day from what Ukraine has to do to what the EU has to do. So everyone has their homework, and EU faces challenges actually very similar to Ukraine. EU, according to Draghi report, now with much higher needs for defense spending, also in the dire need of funding as much as Ukraine. And it is a challenge. So you have financial assets, and the challenge for EU also to make them work. So if you take total financial assets in the US, 20% of them are in deposits, 60% are in securities market. In EU, 30% of them are in deposits, so much more just sitting there. And just 30%, twice less than in the US in relative terms, are in securities. In Eastern Ukraine, in Eastern Europe, 50% of assets, no, almost 60, are just in deposit, doing nothing. In Ukraine, maybe it's even more. So everyone has their homework, and I hope some of it will be done. Thank you.
Definitely, first of all, in order to be competitive, in order not to lose talents, EU has to tackle gaps which were mentioned in the Draghi report, and this report was mentioned, I believe, many, many times today. Gaps in banking union, capital union is important in order to be competitive and in order to compete with US and other markets. And definitely in 5 to 10 years we will sit here and we will host you as a member of EU, for sure.
Thank you. So let's give it up to our panelists. Thank you so much.
Thank you for this incredible conversation. Dear guests, the business part of the first day of our conference is finishing, and I hope that you enjoy this day as we are, but we have And one more exciting experience ahead, our gala evening devoted to executed Renaissance. Hope you will stay with us, but now we need like 15 minutes for preparation to do something on stage. So please, I kindly ask you to take a break outside the ballroom. Then we will back and continue the evening. And the last remark that I have, the next part will be without translation. So if you have headsets, please give them back.